you go. Check your email. Sent you a big, ugly, long first thing in the morning response. Hope it was coherent. I think it will be. Good morning, Bob. Good to see you. Guys, it's Friday, end of the week. Made it. I'm finally getting over this country lag. When you go to the left 3 time zones, man, it's funny how it takes a toll. Used to going to sleep at 9, but it turns out 9 is 7 o'clock here. You're like, holy smokes. Working through that. Um, Having a great time doing it though. Guys, going to forexfactory.com this morning, right? Um, we check news every morning. Fireworks started early this morning. Yeah, um, that's what I heard. I think I was asleep when it happened, which is okay. I woke up and opened up and saw the huge drop down. And I want to talk about that. I want to talk about it in regards to news, guys. Every morning I start by going to forexfactory.com/calendar. And what it does is it typically it lets me know when there's a news release that could affect the market, that could make it jump, bump, spike, drop, raise, whatever. And anytime I see, and you can't see it on here, let's see if we can go to next week and show you what I mean, because there hasn't been a lot of high impact news this week. Of course, I don't have any. There we go. Anytime I see one of these red boxes, guys, that's my heads up. That's that. Hey, Mark, guess what? Somebody might say something that can make the rich guys react. Um, and we look for those orange boxes as well. It can have the same effect. Guys, today somebody said something, somebody did something that wasn't scheduled, and you saw what the market did, right? And Bob B, was it you that said it was untradeable? And what a wonderful word to use to describe the reaction from news. It was untradeable. It was too fast to trade. I didn't have time to see if my rules were met. I would have never had time to get my stops in the right spot, to put my targets where they belong. Guys, untradeable is what we want to avoid. Untradeable means that you can't give the analysis to feel comfortable in your position. Um, so that's kind of a good thing to think about, guys. One of the things I realized over the Christmas break is I'm a NASDAQ trader. I trade NASDAQ. That's what I trade. For me, after the open, NASDAQ was untradeable. It was too fast, guys. I couldn't keep up with it. I'm pretty good at this stuff. It had so much velocity behind it that I couldn't make good decisions and get stops and targets in the right spot. And this just, I had a conversation where someone was telling me, man, I can't trade this damn NASDAQ. I'm getting whipsawed. Yeah, there's a reason, ladies and gentlemen, that I teach on crude oil. There's a reason that Pete only trades crude oil. There's a reason that a lot of the people in this room focus on the S&P and crude oil, guys. It's a smoother market. The rules are the same for either in regards to the basics, but the reality is, guys, is when you take a market that is so temperamental that it tends to overrun, that it tends to whipsaw, that it changes directions and it doesn't necessarily respect the rules, you have to make the decision for yourself if it's untradeable. So I wanted to do that. There's a reason that we talk about the high probability trend trade, guys. It's a trade that is pretty easy to grasp. It's a trade, when you go to the trading guide, I'm going to show you all the good stuff. It's a trade, the high probability trend trade, guys. It is a trade that, where is it? There it is. This is a trade that typically wins 70 to 80% of the time if you follow the rules. This is a trade that, because of that win percentage, it creates a lot of confidence. It gets you focused on rules adherence. You get excited about entering the market when your rules are met. And you should get a little hesitant to enter the market when your rules are not met. Because, guys, rules are a description of a pattern. That's all it is. It's a description of a pattern. I'm going to show you. This is the pattern that we're going to talk about for the first hour. This was this morning in crude oil, guys. Allowing a large chart to give you the advantages you need, and then finding an entry on the small chart. And guys, this is a trade that was $350 per contract. If you gave $100 back or $50 back, By exiting on a reversal bar, the first sign of a slow on the market, guys. If you took this on a four lot, you'd be golfing right now, right? You'd be on the boat. You'd be in your helicopter, Ron, headed towards the Hamptons, doing whatever you guys were talking about this morning. So as we talk about this high probability trend trade, one of the things you're going to do is you're going to study it, you're going to learn it, you're going to trust it, and once you trust it, guys, you're going to want to wait for it. So we're going to talk about this trade, and we're doing it for really no other reason than to give you a way to find success as a brand new user. Because this high probability trend trade, it's going to teach you to read your indicators. Um, Once you can read your indicators, guys, it's gangbusters. Once you can look at your chart and identify three advantages, really two advantages, you're going to find all the other opportunities in that the software provides. Excuse me. Um, and what you're going to find is that patience is going to be, Ron, um, not difficult. It's not. Anyone who's married already knows how to wait. Amen. Um, this high probability trend trade, guys, it's a description of a pattern that happens in the market that repeats itself. It doesn't know if it's crude oil or S&P or even NASDAQ. It's just something that continually repeats, guys. This trade is going to teach you to read your indicators. And what you're going to find is that the majority of your day is reading indicators. The majority of your day isn't entering and exiting the market. It's not being active. It's not finding every swing, every move, every bump, every jump. Guys, you're sitting on your hands and you're making this declaration to the universe. My money is worth having an edge. My money is worth having an advantage. And that's exactly what this trade teaches you to recognize is those edges, those advantages. You're going to understand where the market is likely to continue once you understand this trade, guys. And that means that you're going to be able to pinpoint with amazing accuracy where trends are likely to continue. You're going to use those for entries. You're also going to know where the market is likely to go. This is going to help you with targets, help you get the most out of that great entry. And you're going to understand where the market is likely to stop. These are called termination conditions, and these can absolutely ruin your good time. And here's kind of a picture of it. I took a couple pictures this morning. This is a termination condition, and this is the market taking your money if you chose to trade into it. So we're going to talk about creating these advantages. We're going to talk about recognizing these advantages, and you're going to learn them. We're going to break them down individually in three rules, three looks, three advantages helping you out. So I changed up my PowerPoint just a little bit, and I want to start with this picture. And I hope this isn't intimidating anybody. Your first day in the room, and our rich, rich famous, I'm sure I'm butchering that. Day one, you're going to sit in the class and you're going to wonder, what the heck is he talking about? But what you're going to find is that I say the same thing every morning. I repeat the same thing every morning. I go over the same things, the same rules, breaking them down, teaching you how to study them every morning, and I break them down individually. So we actually don't look for a trade for the first hour. We look for the advantages that create a trade. By day three, the language begins to make sense. By day three, you begin to see things. And typically, if you focus on advantages, what happens is by the end of your first week with me, you're already seeing these trades. It may seem a little fast. You still might make mistakes. Most people will. I still make mistakes. But the forward progress really takes off around day three. So if you're in day one and feeling like you're drinking from a fire hose, congratulations. You are human and doing everything you're supposed to do. Please ask questions. Ask a million questions. And we're going to talk about the indicators. I want you guys to know exactly what you're looking at. And I'm going to do two things for you. The first one, I'm going to give you a link. This is a video where John Novak talks about the indicators that you're going to see on the charts, and he's a little more technical than I'm going to be. So if you need that technical side, that's a great video. I'm going to keep it as simple as I can, guys. If your background on a large chart is green, the trend is up. If it's red, it's down. Unless you're colorblind, this is a pretty easy lesson. You're going to see triggers on both of your time frames. You're going to see small triggers. They're two solid lines. They work together, and they're just called the small triggers. And then there's the large triggers. These are the dashed lines. And these dashed lines are a little slower. So you have small triggers and large triggers. And you're going to see these on both time frames. These trigger lines are going to really show up in everything. They're going to show up in rules 1, 2, and 3. And the only thing that you need to know about them is that these are small and these are large. Little terminology for you. There's also areas on the charts that we use. So I'm just giving them a name. I'm not teaching you how to use them, what they're for, what they do, just how to know what I'm talking about in the room. So there's divergence highs, you're going to see them. And anytime the market goes up and then pulls back down, if the software recognizes a loss of momentum in that move, it's going to print a negative number in a magenta line. Magenta is a fancy way of saying hot pink for you guys from the 80s. And these areas can behave as resistance. You're also going to see red Fibonacci resistance. Resistance is right in the name. It's a solid red line, runs across the chart. And when the market is in an uptrend, you're going to recognize this as a spot that can stop that uptrend, that can halt forward progress. And then the opposite of resistance is going to be support, the blue lines. So when the market is trending down, anytime you see Fibonacci support, you're going to understand that this is an area that could stop the market. You're also going to see yellow one-to-ones. These one-to-ones, depending on the trend of the market, may behave as support or resistance. There's a mid-band that's going to run right through it. It does the same thing as the one-to-ones. When it's magenta, it could behave as resistance. When it's green, it could behave as support. And then divergence lows. This is just the opposite of a divergence high. This is when the software calculates a loss of momentum down here at a pivot, you're going to see that cyan, that baby blue line print off of it. You don't have to know how these things come to be. You don't have to know the science behind them, the programming, anything like that. Learn the names because the names are going to come up in the rules. So there are areas, there are triggers, and guys, we're going to use these indicators to find one trade, the highest probability trend trade. And the way it's taught in this first hour is the absolute best of the best, highest probability, warm fuzzies, unicorns, and rainbows way to take this trade. Ron, here comes your nickel. The high probability trend trade is your first trade. It's not your only trade. This is the trade that's going to teach you to read your indicators so that you can see the other opportunities that the software provides. And it's going to do it with only 3 rules because each rule produces an advantage, guys. Rule number 1, strong trigger lines. We're going to break them down. We're going to do it individually, how to define strength, and that's going to create the advantage of momentum. Momentum is a freight train going downhill with a tailwind on a large chart. And guys, it is difficult to stop. So we look for that advantage because it gives us the opportunity to take a trade in the direction of a market that is difficult to stop. Rule number 2 says termination's false. None of those lines that could stop the market, none of those areas that could reverse the market, that could create problems. When there's none present, you'll have room to your profit targets, guys, and we're going to call that a clear path. So new users, hang on. If you take the time to learn momentum first, and then you learn how to couple it with what we call a clear path, you have everything that you need to build a trading plan that is consistent, that is profitable, that revolves around advantages, guys. Momentum and path, these are your core. And what you're going to see in this room, that the majority of the trades posted, the easy wins, are coming with momentum and path. Your third rule is specific to trend trades. And this is a very, very precise rule, I guess is the word I'm going to use. You're going to use a limit order to buy or sell a pullback in an area inside of triggers. Rule number 3 defines that entry area. That entry area is where the market is most likely to continue. So the recipe for a trade, brand new users, is momentum first, plus clear path, and then your entry area. And if you behave like a flow chart, if you treat it like the only way I'll go to rule number 2 is if rule number 1 is met, it increases the likelihood of success. These 3 rules only take 2 charts to recognize. There's the large chart. The large chart leads the way. I've got my mother-in-law knitting a doily that I can hang on the wall that says large chart leads the way. It's that important to me because the large chart is slow. It's a very broad stroke of a brush. It's very difficult to see change on. And this is the overall opinion of the market. And it takes this one bar on a large chart, the most current bar, the first bar, and you'll be able to define direction, you'll be able to define momentum, you'll be able to define the areas that are problematic. And rules 1 and 2 have got to be met. And when they are on this one bar, you're going to go to a small chart. This is your entry chart. The small chart is the siren song. It will try to woo you into a bad trade when the advantages aren't present on the large chart. Um, but when everything lines up, guys, it's going to show you a retracement. It's going to show you all the movement inside of this bar. This is your refinement process. This is how you're going to be able to pinpoint entries, how you're going to be able to reduce risk, how you're going to be able to maximize profit potential. So large chart leads the way, always. Rules 1 and 2 must be met. And then entries come from the small chart because it increases the ability to manage a trade. We're using these two charts, my favorite metaphor. In my horrible analogies, right, David? You're going to get those throughout the day, especially on Friday, and I've slept. Watch out. Who are you trading with or against, guys? It really is a matter of who you're trading with or against, guys. The large chart is the large crowd. These are the men and women with the money. These are the men and women with the influence. These are the people that have billions of dollars behind them. And when they wake up, they go, you know what? What a great time for the market to drop, the same way you saw this morning. They don't have to give you warning. They don't have to give you a memo. Guys, it just drops the way it did today. These guys made it happen. So trading with them tends to be advantageous. The small chart, these are the small crowds. These are the fluctuations that you see in the market. These are how we're going to find our entry because these folks love to fight the large crowd. They're hoodlums, ne'er-do-wellers, and they create what's called a retracement. And a retracement is nothing more than a little push down when everything over here says up. It's a small move counter to the underlying trend. We use rule number 3 to pinpoint where the small crowd is most likely to fail in their endeavors, and they fail typically 70 to 80% of the time. So rule number 3 shows you where the market is most likely to bounce, where it's most likely to continue with the large crowd, where the small crowd is most likely to fail. This is the accuracy that rule number 3 provides, and this is what's going to let you reduce risk dramatically and give you the most room to get to your next target. Our first hour today, and my first hour every day, because repetition creates recognition, will be dedicated to learning the trigger line and the Fibonacci rules for when it's okay to trade. I am going to get a little bit lectury. I fully understand that. We're going to break down each rule individually, how to identify it, what it means to you, and I'm going to give you all the tools you need to study it. When it's okay to trade means that your rules are met. It's okay to trade when I have momentum, path, and an entry area because this combination gives me an edge. It gives me an advantage. It gives me a testable, repeatable, provable advantage that I know wins more than it loses. So that's what we're going to focus on. You have the ability to simulate, whether it's day 1 or day 1000, guys. There's no reason if you're uncomfortable to put your live money on the market. I never give trading advice. Do what you will with your money. That's okay. Hey, good morning, Caleb. I didn't see you sneak in. So one of the things you can do is every time you take a trade, you can post it in this room. The second half of the classroom is dedicated 100% to feedback. You can post them in the room. I'm going to give you a little bit of help on what helps me give you the best feedback. If you tell me why, if you talk about those 3 rules, and you don't have to go into depth and write a big dissertation, but if every time you take a trade, you go back and write these rules on the chart, whether they were met or not, you can give me a Y or an N. Did I have momentum? Yes or no? What you're doing is you're saying, hey, Mark, I'm learning to read my indicators. Will you just double check my work? Make sure that I'm reading them accurately. And we'll do that. When you get to entries, I'm going to look at your entries and I'm going to say, hey, guess what? You could have saved a little bit of risk by really adhering to rule number 3. You could have maybe held that trade a little longer. Look at where the market was most likely to go, and you jump ship right in the middle of a great move. So every time you post in the room, guys, you're getting a private session with me. I'm going to tell you in person right here in the class the same thing I would tell you if we were on a telephone in a private environment, a Zoom meeting. So don't skip this. Posting in the room is one of the greatest ways to get feedback and to really move forward. The hope is that you learn to practice the correct rules because the correct rules have been proven to win more than they lose. I like to encourage you guys, maybe the first couple days go nuts, get in, get out, have fun, learn the mechanics. But when it's time to dig in, really focus on following the rules. It's that rule adherence that's going to help you find success. We are going to simplify. Obviously, one trade, it doesn't get much easier than that, right? One trade, 3 rules, 2 charts. I'm going to hand you a plan before this day's over. I'm going to drop it in the room in a zip file. The plan that I give you is designed to optimize your chances of success while you learn to read your indicators. Your job is going to be to learn the looks. What looks are you going to commit to? You have to learn them so that they become easy. That's the second step to becoming a confident trader ASAP. Take the time to really take advantage of and use this spreadsheet that I'm going to give you. I'm going to open it up for you right now. And I'm also going to drop it in the room. I just dropped it in the chat box. And just for you guys that are new, anything that I drop in the chat box, you can download it. Easy download, it shows up in your downloads folder. Or you could even just grab hold of it and drag it over to your desktop, to a file, to a folder. But if I post it in the room, it's usually worth keeping. On your spreadsheet, there's 4 tabs. The first tab is the basic rules, and I can't stress enough how important it is to learn these rules individually and then turn them into a trade. So it takes those strong triggers, rule number 1, and I've got how many? We're up to 61 pictures of strong triggers taken from the room. This is stuff that I've done on my own to give you a head start in your study. And then the opposite of strong triggers is weak triggers. So you're going to learn the difference between the two. Rules met, let's look for the second rule. Rules not met, let me sit on my hands and be a little patient. I don't have the advantage I need. And then when you have strong triggers, you're going to make sure that you have a clear path. Again, this is what defines a clear path. It's exactly what it looks like on a chart and what it means to you. And that is the wrong picture. So I may have to get rid of that one. Let me find a better picture. There we go. Small and large, below the one-to-ones, the path is clear. So not only does it show you what a clear path looks like, but it's also going to take the time to create the correlation between your eyes and your brain. So every time you see a clear path, you're going to say, wow, this is amazing. Let me go to my entry. And every time you don't see a clear path, termination conditions, you're going to be willing to say, okay, maybe this isn't my trade. Maybe this isn't the best of the best. Maybe I shouldn't be risking my money on a maybe trade. As a brand new user, really focusing on these 3 items is going to help out. Back to the recognition creates repetition. Guys, there are about 500 pictures of annotated charts stolen from you guys in the room. So Jen drops a picture in, and Jen says, hey, Mark, check it out. I had momentum. It had the potential to break this area. I take the perfect entry, and I got paid, but things changed, so I exited. And I'm going to say, wow, what an awesome looking chart, Jen. You identified the termination, the pivot stop out, great use of the lesson. You had strong triggers without a doubt, and because of those strong triggers, you came over here and looked for the perfect entry, which you find. Guys, look at her entry. It's like a sniper, right at almost the high tick. And then as that market comes down, she finds a way to capture $100. And Jen said, this is not the perfect trade. This is not a clear path. I'm going to manage aggressively. I'm going to be willing to take a break even if it doesn't just follow through. And what Jen did is she just gave me the perfect 50-50 trade with awesome management. So I steal it and I go down here and I say, here's one more study tool for the brand new users. And we're going to call it Jen's well-managed 50-50. And the 50-50 is the second trade on the plan that I'm giving you. So go through and look at these guys, and you're going to start to do a little pattern recognition. I've also broken down the entry, how to pinpoint your entry, the very precise entry, step by step, from the beginning to the bottom. Jen, is a beautiful trade, and that great entry made it so that you could manage, didn't it? That great entry that you took, that's what allowed you to get paid and get to break even. Guys, entries are everything. That's why we focus on them for an hour. And here's two of them, long and short, up and down, whether you're buying or selling the market, exactly how to pinpoint your entry. There's some ideas on management. These are the pictures that go with the management plan that I'm going to give you in the plan. Some ideas on when you can manage a little differently. Things that you're just going to see in the market. Guys, this is my sheet that I've put together. This is my own study sheet. I'm giving it to you so that you can look at my pictures. But I'm going to also give you your spot. This is the trading plan. So every time you see, maybe you're studying and you're going back and you're looking for this pattern, you're going to say to yourself, wow, this is my pattern. This is amazing. This is what I'm looking for. Let me put it into my personal trade setups. Let me look at this for a couple minutes every morning before I get going. Let me remember what the pattern looks like so that I can catch it in a live market. As you grow, you'll learn to manage. I'm here to help you. I will give you an absolutely pragmatic, emotionless management plan in the beginning. But as you start to see things and grow, you're going to work on your management plan, guys. This classroom is a place where you can drop your pictures, talk about what you did, why you did it. I'll give you everything in my powers to help you manage. And then you'll begin to see patterns. Take pictures of them. Drop those in the class. Let's talk about what you're seeing. You may discover the next great trade. Who knows? And then we've got the trade tracking sheet. And this is the one that I think creates the fastest results when you really start trading, because it gives you a place to put your pictures. It gives you a place to say whether or not you had momentum and clear path, those core advantages. And what you're going to find is that there's probably more winners when these are present than when they're not. But the most important thing is going to be the feedback from class. I don't think it's the most important because I think I'm the most important. I think it's the most important because the feedback from class is going to help you fix any mistakes in your chart reads. The feedback from class is going to help you find better entries. It's going to help you find better exits. And if you come back and you look at this section where you type in the feedback, you're going to begin to recognize things that repeat themselves into terminations, into terminations. That was my problem. Guys, I didn't realize I was breaking rule number 2 until I posted in the classroom that my brother used to teach, and he finally said, Mark, how many times are you going to trade into these areas and hope they break instead of just being patient? How much money are you willing to lose breaking this rule? And it turned out the answer was somewhere around 32 million, but I finally worked it out, and he helped me figure out how to break that habit. So you'll see the patterns that are bringing you success, the patterns that are taking it from you, and you'll have the feedback to help you overcome any obstacles. So I can't stress it enough, guys. Use that spreadsheet. It is such a great tool, and it's so often overlooked. All right, there's my spiel for the beginning. Brand new users, the classroom is the same every day. Every day. And this is exactly what we do. So live 5 days a week. Let me get that zoom where it needs to be. I'm going to teach you in the first hour 3 rules on only 2 charts. And we're going to do that to give you the skill set to recognize advantages and turn them into trades. Very often people want to come in and they want to find the trades. Guys, I want you to find the advantages. So each rule will be discussed individually. You'll understand how to use them to enter the highest probability trend trade. Momentum, path, and entry, guys. It reminds you about the core. It gives you the rules, the charts to find them on, the indicators that we use, and then it breaks down everything that I'm going to talk about this morning individually, all the way down to entry and how to study. So I'm going to drop this in the room for you right now, and I want you to know that if you are brand new, everything that I talk about for an hour throughout the day has been consolidated into 2 pages, and it revolves around simplicity, keeping it as basic as you can. Don't confuse yourself. The more parts you add to it, the less likely it is to be the pattern we're looking for. So let's find the pattern. Large chart leads the way, right? Large chart, big slow chart. RCH, Caleb, how are we doing so far? I do know it's a lot to take in the very beginning. Don't be shy. Let me know you're listening. Large chart needs strong triggers, guys, because strong triggers create the advantage of momentum. And if I don't have momentum, I'm just not looking for a trade. So let's not worry about the trade. Let's figure out momentum. Momentum, awesome. I'm a worrier. You'll find this about me. I want to make sure I don't leave you behind. I want you to feel free to be vocal if you have any questions. My whole job revolves around making sure you can read indicators. So don't be shy. This is my large chart, guys. This is the big snippet of it. If the background is green on my large chart, I'm in an uptrend, and I'm only looking for rules to be met for high probability trend trades long. If the background is red, I'm in a downtrend. I'm only looking for rules to be met for high probability trend trade short, guys. The trend is your friend is one of the oldest cliches in trading, but it tends to be very true. In order to have rule number one met in an uptrend, strong triggers. Your small triggers must be up and above the large triggers. The large triggers must be wide. Flat triggers don't have momentum. It's when they begin to open up. That's when the momentum is there. When you have strong triggers, when that separation is between the small and large, the odds are favorable for the market to continue up. One of the ways you're going to see charts annotated all day long, you're going to see OFM, and you're going to see arrows pointing to that separation because strength pushes a market. In a downtrend, smalls must be below the large are wide, the space is present. You're going to see people writing OFM because the odds are favorable for the market to continue down, odds favorable momentum, and this is the first advantage. Odds favorable momentum, strong triggers. It has nothing to do with these price bars. It has nothing to do with Fibonacci areas. It has nothing to do with your desires, your wishes, or your wants, guys. The easiest way, I think, to understand this look and commit to it is that strong triggers look like scissors that are open. And when scissors are open, you can cut. The rules are met. You can get work done. Or as Jerry says, they can cut you a check. So open scissors means strength. Guys, when I have momentum, when my scissors are open, it's difficult to stop this market. This is the look that it takes typically to break key Fibonacci areas. Guys, when I have strength, this will even cover some of the mistakes that I make as a new user, maybe trading into an area. But strength isn't a forever advantage. Eventually, the small triggers work their way back inside of the large triggers. Guys, your scissors close. And when scissors close, you can't cut. You're just taking a stab at things, right? So weakness, anything can happen up or down. So when I talk about that separation, when I talk about that strength, I see this look, I instantly think that the odds are favorable for that market to continue down. And when it goes away, when the smalls work inside, my brain is going to tell me, Mark, anything can happen up or down. That's not an advantage. That is not where you're looking to enter the market. So rule number one is the point of separation, the colors match, and guys, there's that gap. And it goes away when the gap is closed. So you're going to see it during the day. You'll see momentum all through the day, but you'll also see weakness. And this is your red flag that says, hey, you've lost that advantage. Let's sit on our hands and see what happens. And guys, it's not a coincidence that 4 out of 5 pivots, even without the benefit of areas, 4 out of 5 pivots came with weak triggers. 4 out of 5 reversals came with those weak triggers. Strength pushes. So that's rule number one. I wish there was more to it. I wish I could complicate it, but it's really difficult to. My most current bar in the S&P, smalls are above the large. There's space between the two. Ladies and gentlemen, the odds are favorable for this market to continue up. Is it always the smoother, seamless, or is the background sometimes? Oh yeah, no, it's not always. So let me find you an example, Caleb. Great question. Let's find a spot. And remember, this is a very big chart. It's a slower chart. It's a broad stroke of a brush. But in times of, there's kind of an example. It goes from red to green for just a moment, then red, then green, then red. And the great thing is about this look right here, Caleb, is you don't have rules met to take a trade. When it's bouncy, when it's flashing colors, when it's going back and forth, rule number 2 will keep you out of this one. Rule number 2 will keep you from trading into this area. Rule number 2 will keep you from taking a loss here. Rule number 1 will keep you from hoping the market goes up. And this is why I talk about 90% of the day. The colors are just a trend, and the colors are telling you this is the direction I should look for my rules to be met. But then that's it. That's the extent of the colors. Then we go into looking for those strong triggers. Looking for those strong triggers. And if I have the strong triggers, I'm going to make sure that there's not something in the way to stop that market. And Caleb, this is where you're going to see how these rules work together to help keep you safe. Termination conditions are areas that may reverse the market, guys. And these areas are the same ones that I gave you the picture of. The areas, the blue Fibonacci support, the red Fibonacci resistance, yellow 1-to-1s, high and low divergences. There they are in a picture. And these areas are where that large crowd are making decisions. That's what I want you to think of them as. So if the market is pushing up and it reaches a magenta high, it reaches resistance, it reaches yellow 1-to-1s, you're going to say to yourself, oh my gosh, the people that control the market are going to react here. They could create a spike, a reversal, a bounce. They might even break it. I have no idea, but at least I know where that decision is likely to be made. And identifying a termination condition works on that idea that these lines, these areas on a large chart are where the large crowd is making decision. So to define a termination condition, we're going to let them get there. We're going to let those price bars come up and reach Fibonacci resistance, because when they reach resistance, there's decisions that are going to be made. Maybe the buyers will exit their position. Maybe the sellers will show up and try to take over. Maybe there'll be a crazy fight between the two of them that I don't want to be a part of. I never know what the reaction's going to be. So if price reaches an area of resistance, the only thing I have to do is ask myself, where are my triggers? And if they remain below resistance, this is how we define it as a termination condition. And if it's a termination condition, rule number 2 is not met, and that means absolutely no long trades into that area. And what it is it's a safeguard. So the market reverses, and it's coming down, and momentum is great, and life is good, and then price, those dynamic Renko bars, they reach Fibonacci support. They touch, they come in contact. And once that happens, I just say to myself, hey, where are my triggers? Of course, Caleb. Of course. Let me address that in 1 second. If price reaches support and the trigger lines remain above support, support's a termination condition, no trades into that area. That is the most basic form of rule number 2 for us. Price reaches, where are my triggers? And guys, perfect, perfect, perfect. 3 termination conditions. So Caleb, I'm not a math guy, but the one thing that I've found to be true is that anything that wins 70 to 80% of the time is obligated. It's just math to lose 20 to 30% of the time. And the idea, Caleb, is that we don't get to pick that 20 to 30%. We don't know when it's going to happen. Hell, we may have a run of 10 where we never lose. We may take that whole 30% in the first 3 trades that we take. But what you're going to find is that when you learn this pattern, and that's all this is that we're talking about. We're talking about a pattern that takes 3 advantages and pieces them together to create a trade. If your rules are met for this trade, Caleb, this trade is testable. You'll be able to test it, go back, prove it. Take 100 pictures of this pattern being met. Take 100 pictures of having those advantages, and what you're going to find is that 70 to 80% of them win. 20 to 30% of them do not. So the idea is consistency. The idea is believing that when you hit a termination condition, it's okay to not trade. When you have momentum and a clear path, that's when you're looking for your opportunity. Does that make sense? That's a great question. Um, I've heard that there's people that'll tell you, oh, 100% winners. Guys, I've never met a 100% winner trader. I've met traders that make tens of $1 millions a year with their trading, and they lose trades. But they lose the right trades. They lose the trades where their advantage was present, where their edge was in place. And that's all we're doing right now is we're defining an edge so that you can understand when it's time to trade, when you have that advantage. A clear path. This is rule number 2 being met. So clear paths come from 2 situations. The first one is if Fibonacci breaks. So right here we have a termination condition. Price reaches resistance. The triggers are all below. The trigger lines tell the story, guys. Once your small triggers and your large triggers get above this area of resistance, this area of resistance begins to behave as support. It's no longer in the way. I've got a clear path all the way to reach Fibonacci resistance. So we don't trade into areas, rather we trade from areas. And then once we hit this one, there's our termination condition. My triggers are below resistance. I can't go up, but if that market reverses, there's nothing in my way. Price doesn't reach that area until all the way down here. And this is how you get a clear path from a reversal. When that market reverses from a key area, you've got a clear path until you reach the next area. Or when your trigger lines break above an area, below an area, you'll have a clear path until that next area. Does that make sense? The difference between a termination condition and having a clear path. And this is as black and white as I want you to keep it as a brand new user. Let it either be a termination or a path. And you'll have to study it. You'll have to practice it a couple times. But what you're going to find is that when you have momentum, when you haven't reached that next area, guys, these are the easiest trades that you'll ever take. When you have momentum and path, and I want you to see this picture. This picture was taken, I don't even remember, maybe a week or 2 ago. When you have momentum, when there's nothing in the way to stop it, what happens is you've got a freight train and nothing to create a bounce to try to reach that next area. And you've got a freight train and nothing to create a bounce to reach that next area. This is that pattern being met this morning. This is that pattern coming to fruition this morning. Strong triggers, small and large triggers get below those fibs. This is your first 2 rules met, Caleb. This is momentum. It's always momentum. And this is the path. And now we're going to learn how to use that refinement chart to pinpoint where the market is most likely to continue. And you're going to be able to use that and capitalize on that to ride that momentum and path down to the next key area. I want to go back to that live market. And I wanted to show you what we saw as we were talking about this morning. Resistance and absolutely no triggers through. Even with an uptrend, even with momentum, this could create a loser. There it is in a downtrend. Support, support. Guys, there's that mid band. Large triggers a full bar away. There's weakness creating a reversal. There's price reaching a divergence low, and look at that big bounce that it creates. And here's the cool thing, is once that support breaks, you can see how the market comes back and uses it as resistance. That's going to help pay dividends. There is one of those divergence highs stopping the market cold. So rule number 2 for the brand new user is designed to do a couple things, guys. Most importantly, it's going to keep you out of trouble. It's going to keep you from trading into areas that could stop the market, that could create a bounce. Rule number 2 is the most broken rule because it creates the need for patience. It creates the need to sit on your hand, to do nothing, to be patient, to give yourself those advantages. So there's an easy way to go through and study this. And let's go to the live market right now. because crude oil has reached Fibonacci resistance. Do you see how none of the triggers are above that area of resistance? Caleb and Famous. That's your termination condition. That is textbook. And what that's telling you is it's okay to sit on your hands. It's okay to do nothing for a minute. Let's see what the reaction's going to be. Let's see if they're going to break it. Let's see if it's going to reverse. And there it is again. Rule number 2, from termination to termination to termination to termination to no momentum termination to termination, defining consolidation. And that's my next picture. Rule number 2, I don't know if you have experience in the markets. Guys, chop and consolidation tends to beat up traders because we start to form opinions rather than embracing advantages. And rule number 2 will keep you out of that consolidation. It'll keep you out of that chop. And once it breaks out, once that momentum and path is there, you'll be able to find a way to capitalize. So a lot of patience goes into being a day trader, being a successful day trader. And the most successful traders simply do nothing when there's nothing to do. Are you guys good with that? Feeling all right? Termination conditions, if price reaches an area, the triggers are below, maybe we sit on our hands. That's up to you. It's a decision you can make. And I want to go back to this one more time. It's a lot. In the very beginning, it's a lot. Become familiar with the terminology. Become familiar with identifying a trigger line. Become familiar with knowing what the areas are. And then be willing to just break it down individually, making sure that you understand momentum first. And once you understand momentum, we'll move into termination conditions. Maybe it takes me 3 or 4 days to get good with that recipe of price reaches, where are my triggers. And then once I've got those two, guys, we're going to go define some entries. We're going to go get into the market. We're going to learn how to enter. You're going to be given a plan for exiting. But first, I want to talk about one phenomenon that happens on the big chart and the little chart, but you'll see it on the small chart first, guys, and that is 3 divergences. 3 divergences, 3 losses of momentum, 3 cyan lines from a low, or 3 magenta lines from a high. 3 divergences can terminate a trend. 3 divergences means that the sellers were pushing and the buyers stole their momentum. And when it happens 3 times right in the same range, this is the only reason not to take a high probability trend trade. This is when the advantage of rule number 2 is gone, and this is the only small chart termination condition. When you see it on a small chart, that's where you tend to get those little pushes up higher on the large chart. That's when those key areas don't break. Sometimes this will help you identify reversals that seemingly come from the middle of nowhere. So 3 divergences on a small chart says don't take that high probability trend trade. 3 divergences on a large chart very often produces a much larger push in the direction after the reversal. So rule number 1, large chart, slow chart, broad stroke of a brush, must have strong trigger lines. Rule number 2, once you have those strong trigger lines, the advantage of momentum, you're going to make sure that you've got room to your profit targets because we're here to get paid. Once these are true, rule number 3 says that you're going to go to a smaller chart, a faster chart, that refinement chart, and you're going to use a limit order to buy or sell a pullback at areas, fibs, mid-bands, and yellow 1-to-1s. Because the same way on a large chart, guys, those areas, where's my areas picture? These areas on the large chart can stop forward progress of a trend. On a small chart, they can stop forward progress of that small crowd's fight and create a bounce in the direction of the trend. So we're going to enter at areas, and we're going to do it inside of triggers, large triggers, because large triggers are where you're going to define the retracement. This is kind of what it looks like as a whole trade. Rule number 1 is met on the large chart, the advantage of momentum. Does everybody see that? The momentum look has nothing to do with areas, entries. It's simply a separation between the small and large. Once I have the advantage of momentum, the market's trading down here, guys, and I'm making sure that I haven't hit an area, that there's not a fib, that there's not a yellow 1-to-1, that there's not a divergence low. I have nothing in the way. I'm not trying to break through anything above me. rules 1 and 2 are met. When rules 1 and 2 are met, guys, the market is screaming in the direction of the trend, and it's all the way down here. And you're saying to yourself, oh my gosh, how am I going to make money with this software if everything's going without me and I don't get my rules met? Well, you're going to get a reversal bar. Small chart fluctuation, small chart fight, guys. And once you get this reversal bar, you're going to be able to define where this retracement is most likely to go by using these large triggers. So the smooth large triggers are native to the 5-1. That's how you can determine that you have the momentum that you need. These stepped or dashed, we call these synthetic because these large triggers are the large triggers from your large chart. This is how the accuracy comes into place. Once you determine where the market's likely to retrace, you can say to yourself, it needs an area to bounce from, a fib, a mid-band, yellow 1-to-1s, and they have to be in that retracement zone. And guys, this is how the accuracy comes in. You're literally going to call your shots. You're going to wait for the market to come to you at one of those areas inside of triggers, and this is going to be your high probability trend trade entry. And it is 100% preceded by strong triggers and a clear path. So for a short trade, selling the market, going down with the trend. This is one of the beautiful things about futures is you can make money either way. Everything says down, the momentum is strong, the path is clear, and the large chart tells me to go look for an entry. My job is to patiently wait for a reversal bar, to wait for the fight, the retracement to begin. And that's what this signifies. The retracement has begun. I can define where the retracement is most likely to go by using the large and synthetic triggers. The tighter those triggers are one on top of each other, the smaller that retracement zone becomes. That's going to help with accuracy. But then I have to say to myself, trigger lines are not my entry. Reversal bars are not my entry. My entry is going to come from an area, fibs, midbands, or yellow 1-to-1s, inside of those trigger lines, inside of that retracement zone. And guys, you have one area in this particular trade. It's a midband. That midband signifies where the market is most likely to bounce and continue with the trend. That midband is the spot where the small crowd is most likely to fail. This is your entry pattern from reversal bar to retracement to entry, about 2 ticks below that midband. And once you're in the market right here, you have 3 advantages. You have the advantage of momentum on a large chart, you have the advantage of a clear path on a large chart, and you have the advantage of having entered precisely where the market is most likely to continue with the underlying trend. Because you can identify retracement zones, because you know where it's most likely to bounce, and this will take a little study, a little practice, you're going to learn to accept that anything beyond those triggers isn't where you want to be. That's where the advantage of rule number 3 is gone. Anything above these triggers for a short trade, I call it the wrong side of the triggers, because once you end up there, you don't know if the market's going to continue down. You don't know where the market's going to continue down. Advantage 3 is lost. So you're going to ignore these lines. You're not entering from the wrong side of the triggers, insisting on getting into the market where the market is most likely to continue. In an uptrend, large chart, the background is green. Large chart has odds favorable momentum. Large chart has nothing in the way to create a bounce. And it is flying on a small chart. And you are saying to yourself, egads and little fishes, how am I going to make money? And then that magical reversal bar, that pattern that repeats itself every day. There's your reversal bar, and you're like, whoa, reversal bar is not my entry. That's the beginning of the pullback. That's the start of the fight. Well, where's that fight most likely to go? Somewhere from the top of those triggers to the bottom, large and synthetic. Somewhere within this big red box, those price bars are going to return. I don't know where. But triggers aren't bouncy. Triggers are like clouds and you're a skydiver. You need something solid. Something solid to create a bounce, guys. Fibs, midbands, yellow 1-to-1s. Here you have a midband. It's up there at the top of that retracement zone. But here you have 1-to-1s, and it's a little lower in that retracement zone. I don't know which one's going to create the bounce or if it will at all. But I know that I have a window. I have a zone where the market is most likely to bounce, somewhere in the retracement area is where the market is likely to go down. There's my yellow one. And then I'm going to say with a white bar, it may go to the mid-band and continue up. That's one option. It may go to the one-to-ones and continue up. That's my second option. So this blue shaded box is a window. I like to call it the window of opportunity. And I know that somewhere in this box is where the market is most likely to create an impact, to bounce, to continue in the direction of the trend. When you understand the idea that it's a window and not a precise to the tick methodology, if you enter 2 ticks above the highest form of support and the market continues down here, you're like, I'm okay. I'm still in the retracement zone. I'm still where it's most likely to bounce. Even if it gets a little below, you're like, I'm right where the market's likely to retrace. I'm okay with this. Does that make sense? But once you get below those triggers, once you get outside of that retracement zone, you're ignoring these areas. That's where the advantage of rule number 3 is no longer in play. That's where you are through all of the good stuff that may create a bounce. And guys, this is where the market should not go. You don't know if, you don't know when, you don't know where that market may continue up. So you're going to use that concept. And I always tell people, give it about 10 days. 10 days to study these, to go back, to take pictures, to ask a million questions, and you will be able to pinpoint where the market is most likely to continue. And because you can pinpoint where the market is most likely to continue with the trend, you know where the market should not go. You're defining it through your understanding of rule number 3. This is where initial stops are placed, guys, where the market should not go. Generally 4 to 5 ticks above the trigger lines for a short, below the trigger lines for a long. This is where the advantage of rule number 3 is no longer in play. Guys, I don't want to be in the market where I don't have an advantage. I don't want to be in a long trade if they can get through everything that typically stops them. And Caleb, this goes back to your question. Are there times when the rules are met and the market will go the other way? Absolutely. 20 to 30% of the time, they're going to come get this stop. But you know what? I'm going to make them come get it. I'm not going to offer myself up in the retracement zone. I'm not going to put a stop at an area inside of triggers. I'm going to force them to do all of the work to come take my money. And if they do, it's a cost of doing business. It's a normal part of a positive equity curve. And once you study this pattern, once you learn to believe this pattern, what happens is you begin to lose your fear of losing. You begin to lose your fear of losing. That's a lot of loss there. Because you understand that you're not in control of the wins or losses. You're in control of the execution of the method, insisting that you have momentum, demanding that your path is clear, and having the patience to wait for the pullback to the area inside of triggers. So this is the pattern, and this is how you'll study it. One of the things that you guys can do, and I think this is the greatest way to get good at this, is when the rules are met on the large chart, when you have momentum and path, I want you to look for those tails the same way we did right here. Potential to break, there's a tail, just circle it. Scroll back again. If you see it again, that's the one I showed earlier, just circle it. Get in the habit of circling tails. And what you're doing is you're pinpointing where that trade may have come from. You're pinpointing on the large chart where the trade may have come from, but you're going to go back to a small chart. I think that's the previous circle, maybe. And you're going to ask yourself, are my rules met? So let's do this together. I'm going to take off our cheater circle. So brand new users, play along with me here. Do you see how this chart has odds favorable momentum? Caleb and RCH in famous. Do you see it? Aaron, do you see it? Everybody sees it, right? Nobody's talking because this is tough. I don't want to be wrong. I love being wrong. Mark, I don't see odds favorable momentum here. I don't think rule one is met. Well, let's go back to a lesson. When there's separation, when the colors match, this is your precise look on the large chart. Price has not reached an area yet, and my triggers have cleared the previous area. My path is clear. So on my small chart, I need a reversal bar, and it goes down and down, and there it is. There's my reversal bar. And at the time of the reversal bar, I'm going to say to myself, somewhere from the bottom of those large triggers to the top of the large triggers, that's where the market's most likely to bounce. That's where the market's most likely to retrace. But the market's most likely to ricochet and continue down somewhere from the highest level of resistance to the lowest level of resistance. My job is to right click. Well, the market's trading in the wrong place. I'm going to right click and I'm going to activate a sell limit. And I'm going to have it just waiting a tick or two below that mid band. And if the market comes up, I'm in a short trade. I've entered the market with the advantage of momentum. Hey, good morning, Miss Cindy. Happy Friday to you. I've entered the market with the advantage of a clear path. I've entered the market where the market is most likely to continue. And sure enough, it dances for a second, but down it goes. This is your entry. It never got beyond the retracement zone where the market shouldn't go. It bounced right off the mid band inside of triggers. Guys, this is all we've talked about. And what you'll see is that the top of this move, the top where the entry came from, is the top of that tail with the rules met. This is an amazing way to go back and study this pattern. So if I back it up again, let's see if the large chart, there's my reversal bar, there's my pullback to support inside of triggers. It dances right back to support inside of triggers, never gets out of the retracement zone, and with all that momentum, continues right up to Fibonacci resistance. And sure enough, that's where the market reversed. So when I spend an entire hour, I think that's my assumption too. I spend an entire hour every morning. Jerry, I'll find out for sure and get you an answer. I sent John a message, but John likes to ignore every third message that I send him. So for my newer users, for Caleb, for Famous, for all you guys that are like, wow, this looks awesome. How do I get there the fastest? Because that's always my thing. Chart reading 101. I'm going to give you all of these documents that I'm sharing with you. They're in this zip file that was just dropped into the room. The goal is that you start by looking at your large chart, guys, that you don't concern yourself with entries, with trades, with making money, but rather learn to recognize a couple advantages, learn to look at them, to see them, to speak them out loud and scare the hell out of your cats. So that the fastest way to get there, take 25 pictures. Go back and take 25 pictures of strong triggers because that's your commitment to take a trade. Go back and take 25 pictures of weak triggers because that's your brake pedal. That's the hold on, let me relax, it's not time yet. Go take 25 pictures of a clear path of termination conditions. And guys, when you take those pictures, drop them in your spreadsheet. But don't just take pictures. Take the time to annotate. We did this one in class together. Take the time to say that the smalls are below the large, that the colors match, that the scissors are open, that this is strong, that this is odds favorable momentum. And what you're doing is your eyeballs see this look, and that's what your eyes are looking for. But your brain is telling you that you have the advantages you need to go look for rule number 2. And then once you have momentum, you're going to say to yourself, let me make sure that my small and large triggers are above the area. Let me make sure that I have a clear path because this is the easiest way to make money when I have momentum. And if it's trading into an area, well, then I'm just going to pump the brakes. That's not my trade. That's not where I need to hope to make money. I'm going to find a way to capitalize here. And I'm going to tell you guys right now, Once you can identify momentum and path, you're going to find a lot of creative ways to make money with this software. You'll probably see it in the room today. I'll try to point it out to you. Um, and then to take these pictures, it doesn't make sense for me to go, hey, you listened to me for 30 minutes, go take pictures. Let me give you pictures of the pictures you're going to take. Let me give you the writing of what the rule is. Guys, this is your high probability trend trade checklist. This is the core that builds the plan that I'm going to give you. It asks you, is the market coming from a strong top or bottom? This is the first thing on the checklist. This is not a rule for the high probability trend trade. You can take a high probability trend trade without when the three rules are met. But if a termination condition, one that absolutely no triggers get through, reverses the market, that strong top, that impactful decision by the sellers to take over, it sets you up for the highest probability trend trade you could ever take. If a termination reverses the market from a low, it sets you up for the highest probability trend trade you could ever take. Not sure, Josh. Go ask that in the other room for me. I'd have to stop and look and find the chart prime. I believe it's pro, but I'm not sure. If you ask it in Traders Chat, John Novak will probably pop in and get you that answer faster than I can. Sorry, man. So guys, a strong top or bottom creates a warm, fuzzy feeling that gets you excited about whatever trade comes after it. A strong top or bottom is going to be mandatory for the second trade on the plan that I give you. A strong top or bottom is rule number one for a couple other trades that Nexgen teaches. So every time you take a trade, just define where the market's coming from. If it's not a strong top or bottom, it's okay as long as the rules are still met. If it is a strong top or bottom, you should puff your chest out a little bit and feel good. Second item on the checklist is, do I have strong triggers? Do I have the separation between the small and large? Or do I have those damn anything can happen triggers where I don't have an advantage? Only one look sets you off for rule number two. So when you're taking pictures, make sure that the pictures look like this for strength. Make sure the pictures look like that for weakness. Then it's going to ask you about termination conditions. And guys, I created this picture and I'll drop it in the room. This used to be a part of the PowerPoint, but I thought it maybe was a little too confusing. When the market is trending down and it reaches Fibonacci support, there's a stop sign. Price reaches support, the triggers are still above. This is the termination condition. This is absolutely no trades into the area if you're looking for high probability trend trades. You can only resume trading when both the small and large work their way below the area of support. It behaves as resistance. The path is clear until you reach the next area. So there's this transition. Whoops, you're not going to be able to see through that. There's this transition from termination to clear path. This is going to be the second trade on the plan that I give you. This is the one that Jen took expertly this morning that I showed you and put in the spreadsheet. There's what we call a 50-50 trade. And when 50% of my triggers absolutely smash through an area, 50% of my triggers, the large, are hanging behind the area. As long as I have that strong trigger look, this fib has the potential to break, but it's not a clear path yet. Clear path is defined by the triggers, both sets getting below the area. There are a lot of opportunities in this 50-50 trade. This is a medium probability trade. But because it's not a clear path, because you don't have nothing in the way, trades must be managed assertively, guys. Profits get taken a little bit quicker. Getting to break even happens a little faster. And once again, this is going to be the majority of your trades. The small triggers absolutely smash through the area. The large triggers haven't quite made it. The entry is absolutely perfect in this medium probability trade. Quick profits were taken and getting to break even because all it is potential. And once again, Jen, this is just going to be the benchmark for today. Aggressive management because the path isn't clear. So that's going to be on the plan that I give you as well. Make sure that you know the difference between termination and clear path, and then understand that's going to open the doors for more trades. And then defining entry, area inside of favorable large triggers, all the way down to where your order goes. The second page is just the checklist without the pictures, guys. I'm gonna say you should probably, you don't have to, but you should probably print this out. Put it on your desktop. Learn how to start focusing on rules. Every time you take a trade, win, lose, or draw, I don't care if you followed the rules or you didn't follow the rules. If you start from day one or you get back in the habit of defining where the market is coming from, just type on the chart, strong top or bottom, yes or no. Define the momentum. Write strong triggers, yes or no. Um, did I have a clear path? Define it, yes or no. Whoops, hold on. I got you, Jen. Better? And if you always write, did I take an entry from an area inside of triggers, and you capitalize it and change the color of it and draw flowers around it. Area inside of triggers, guys. This is going to keep you from taking the wrong entries quite often. And this is your roadmap as a brand new user. Nobody in the history of this checklist learning these three simple concepts and then adding that strong top or bottom. If you mark yes truthfully, nobody in the history of this checklist has ever been able to return to me and say, you know what, Mark, I only hit 40% winners. Everybody has been north of 70%. I have had engineers put it through the ringer, backtest, simulation, 400 days, and their final outcome was like 82, 83%. And that's why this highest probability trend trade checklist, guys, it is the first trade on the plan that I've given you. The plan is the KISS plan, the keep it simple sunshine plan, because I can't call you stupid. Apparently it's a bad thing. This plan is a stepping stone. This is the beginning. This is your foundation. This is the first trade, not the only trade. And it's designed to optimize your chances of success, guys. This is the 100% best of the best way I know how to teach you to take this trade. This offers the highest chance of success as you learn to read your indicators. And then through simulation, through study, through class feedback, through continuous practice, you will create your own plan. You'll find more opportunities. You'll find different ways to manage. You'll find different ways to enter. You'll be able to capitalize on your ability to read indicators. Until you can, this gives you something that can help you become profitable before you can write your own plan. And I'm going to tell you, there are people, there are men and women that have followed this plan in their first 30 days with Nexgen and got funded in prop firms, guys, that got not just past the outcome, but got to the point where they're trading live in prop firms using this plan. This is where I remind you, there's two things that you have to know before you enter the market and you're not on simulator. When you're on simulator, you're learning these things. You're practicing these things. You're trying these things. You're posting in the room and make sure you're doing it right. But once you get off simulator, when it's time to put rubber to the road, you have to know why you will enter a trade. That's what we've just discussed for an hour. I will enter a trade because my rules are met. It almost sounds like kindergarten, right? Rules are a description of a pattern, guys. The pattern has been proven. You will be able to prove by going back, circling those tails, looking at it, looking at the 500 pictures on the spreadsheet of Nexgen clients, not Nexgen employees, Nexgen clients showing the trades that they take with the software. And once you learn to trust it, there's no reason that you'll ever not enter the market. You'll learn how to squash your opinion a little bit. And when you know that pattern wins more than it loses, you begin to accept losses, which is hard in the beginning. It's hard to take a loser because you begin to question everything. Guys, following rules helps remove emotion. It really does. And then you're going to have to know why to exit. And the easy answer is you exit because it hits your profit targets. That's the best case scenario. The other side is when the advantages that got you into a trade go away, it's time to exit. So if I enter a trade and my triggers are no longer strong, I might exit. If I enter a trade and I hit an area, I may exit. If I enter a trade and it goes 4 to 5 ticks beyond those triggers, I may exit. And then once you define entries, and I want to talk about how great entries create manageable trades. Great entries give you the opportunity to make money even on trades that fail. Yes, Jen, here we go again. Jen took a medium probability trade. Look at her entry. Blow that thing up. You get the princess tiara today, Jen. Like an absolute sniper at the area inside of triggers. She made $100 right here. She was able to get break even before the trade failed. Your great entries will create manageable trades. Your great entries are going to reduce risk. Your great entries are going to help you maximize profits. So define your entry. Take the time to learn those entries. Commit to learning those entries. Ask for all the help that you could ever need in defining those entries from me, because I want you to learn this trade. But then you've got to manage it. You've got to do something with it. And this is where that nagging little what if, I hope monster sits on it. Not seeing it, seeing trend trade chart. Uh-oh. Let me refresh it. Screen 2, go live. Is that better, Ron? What are you doing in the UK? No? Hold on. I'm going to stop streaming one more time. So let me ask this question. Can the rest of you see what I'm showing? Yep, that's it. You guys can't see it. Why didn't anybody tell me? Cav can, Steve can't, Anna can't. How does everybody sit there and not tell me? Silly people. You're everybody, Ron. The wind beneath my wings. So let me do this. Hold on one second. I'm not going to end the class, but I'm going to do a little reboot on my Discord. So I'll be right back, and hopefully that kind of sets us in motion again. You can probably hear me. I'm going to reconnect. I'm going to get into that education room, and I'm going to bring up the chat. Can you guys hear me? Okay, you can hear me. We're halfway there. How about a screen, guys? Did we get that in there? Feeling good? Yeah. Life's like a box of chocolates. Ron, are you serious? Manage. Okay, that's where we're at. That's exactly what we're looking at. You're good. Guys, you got to learn to manage your trades. The KISS plan is the most emotionless plan I could ever build for you guys. And the KISS management plan is designed to help you understand and trust stop placement, because you've got to know where the market shouldn't go. You've got to understand how to protect your investment if things go wrong. But more importantly, it's focused on getting you paid. Because I don't know about you guys, the only reason I wake up early is so that I can make money. Otherwise, I'd probably sleep in. So your KISS management plan is very, very emotionless. It's based on 2 contracts, and it is dependent on your ability to take the correct entries. So it's if then. That's all it is. If then. New users, I encourage you to try to follow this for a couple weeks as you learn to read your indicators, because it really is designed to get you paid quickly. If the entry is 2 ticks below resistance inside of triggers, then my initial stop is 4 to 5 ticks beyond the triggers. The same thing we've talked about all morning, because this is where the market shouldn't go. If this is going to be one of those 20 to 30%, that's where the market shouldn't go. If I try to get clever and reduce risk, and I say, you know what, I'm going to put my stop on the other side of the mid-band, because the mid-band could stop it. And guys, they're going to come up, they're going to tap your stop, and they're going to run without you. And you'd be like, okay, I need to be a little more clever. Let me put my stop on the other side of the areas. Whoops. And they're going to have that camera behind you that you didn't know about, and they're going to come up and tap your stop in the retracement zone, and they're going to drop like a ton of bricks. I've seen it a million times. So you have to learn to accept the risk. And the risk on this trade is about $150 per contract. Your targets are predefined, $100 and $200. If they don't come get you, if they don't find your stop, it means that you're going to get a reversal bar in the direction of the trade. And when this happens, we call this a confirmation bar. When the rules are met, this is a confirmation bar. This is confirmation that the market is going down without odds favorable momentum. This is confirmation that it's going down with that clear path. It's confirmation that it's going down from that area where it was most likely to bounce. And guys, all that confirmation will have you redefining where the market should not go. That trade is working. It's working in the direction we want it to work. And your new stop will be 2 ticks above that reversal bar. And that $150 per contract is now $30 per contract. Great entries, reduce risk. Here we go again, Jen. Where was Jen's picture? When Jen got a reversal bar on this trade, here's her entry. Once the reversal bar printed, Jen, you had what, 2 ticks of risk, maybe 3, because you bought the high tick, sold the high tick. Maybe 2 or 3 ticks of risk, guys. That feels good. It doesn't guarantee a winner, but what it does guarantee is that if you take a loser, it's a very small loser. It's an insignificant loser. It's a doesn't even make you sweat loser. If it doesn't come hit your stop, that's when the magic happens, guys. Your first target is $100 away from that amazing entry. Even on trades that fail, it's hard to not hit it with that level of momentum. And if price reaches your first target, 1 contract is automatically removed. Those funds go into your account. With 1 contract remaining, you're going to move your stop to break even. You're going to move your stop to absolutely no risk, but you will notice that I didn't say where the market shouldn't go, because you're still at an area inside of triggers. It may come get you, but you've already made $100. The fact that you've made $100, that you have no risk on the trade, this is what creates trust in the large chart, because now you've got nothing to lose in a large chart that is screaming in the direction of the trend with nothing in the way, and it's more likely to hit that blue fib than it is to turn around and hit your stop. So with absolutely no risk, you're learning to trust that the large chart is more likely to push you to that $200 target, which means at the end of this trade, that's a $300 trade. $300. Some of you are saying, but Mark, I need to make more than that. I need to make more than $300 a day. My professional career exceeds that number. Guys, this is not your trading day. This is your trading moment. This is a flash in the day. This is 2 to 3 minutes in that day. That is 1 trade based on all the advantages. But if you did stop right there, guess what? That's a $75,000 year based on 252 trading days in a year. That's it, Gary. And Gary just said it. Make $300 a day before you shoot for $3 grand. I can't tell you how many people insisted on $1,000 a day, made it to 800, and end up negative. Learn how to stop. Learn how to be consistent, guys. It's consistent profits that change your career path. It's consistent profits that buy nice things. And the beautiful thing is, and I put this in here, use these advantages. Find a way to capture $100 a day. There are trade copiers. You can mirror that $100 on 10 accounts, turn that $100 trade into $250,000 a year. You're not taking more trades. You're simply spreading it out. Base hits pay bills. Amen, Ron. So guys, focus on that. Focus on getting paid consistently. You don't have to make all the money. You don't have to be in every move. You don't have to be the first one in. You don't have to be the last one out. The easiest money you will ever make will be trading away from Fibonacci areas and being willing to stop when you reach them. Learn what gets you out of a trade. Gary, when your advantages go away, That's the problem. So hopium is one of the phrases you guys are going to hear in this room. What is hopium? Hopium is, well, there's a strong trend. Hopium is seeing the market hit an area, but hoping you can make more money. Hopium is seeing a red background and deciding to go short even though the rules aren't met, believing that the market has to smash through that fib. Hopium is believing that without momentum, the market is still going to push. Guys, these three rules, these three very basic rules, are designed to eliminate hope and get you speaking in terms of advantages. So, Gary, when you lose your advantages, exit a trade. But I'm going to say it again to everybody. If you're not consistently making $400 to $500 a day, why not? What is it that's changing it? Trailing stop still divergence. I like it. So you know why, right? You know why you'll exit a trade. That's a good one. Loss of momentum, especially on the time frames you trade. I love it. That's a good plan. But it's a plan, right? Gary, if someone asked you on the street, "Hey Gary, what gets you out of a trade?" You would say instantly, divergence. Divergence gets me out of a trade. If I don't get it, I don't exit. Pretty cool. I like that. So guys, we have gone through in this first hour and a half, because I love my new people and I want you to get it. We've talked about the trigger line and the rules for when it's okay to trade. We've broken them down individually, what they look like, what they should mean to you. You have the ability to simulate, to practice, to post in the room, to get feedback on every move you make in this market, to get feedback on every picture you take when you don't understand something. And you'll get feedback from the questions that you post in the room, guys. My favorite thing in the world is for this room to be a discussion, not a lecture. And I know that the first part's a little lectury. You have a plan now. You have the KISS plan. I've dropped it in the room in the zip file. I'm dropping it in one more time while I hopefully have your attention. Inside of that zip file, guys, is the PowerPoint that I used to teach. It's the Chart Reading 101, the High Probability Trend Trade Checklist. It is the KISS plan. It's even those daily goals reminding you that you don't have to make it all. And then it is as well everything that we've just done. From how I do it, why I do it, where to find it, what indicators you'll use, all the way down to being able to go back and study those tails, guys. All of that. You have everything that you need at this point to be successful with the software. The one thing Nexgen hasn't figured out how to bottle and provide is experience, is the repetition, is the time on the pond, the seat time, whatever you want to call it. All you need to do now is repeat, 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 repeat. Study, study, study. Practice, practice, practice. Guys, the greatest golfers in the world hit 1,000 golf balls a day when they're not in a tournament, because they know that that repetition creates the results. The process creates the results. Michael Jordan used to talk about shooting hundreds of free throws every day. Everybody else would get off the court, he would stay on and he would shoot free throws so that when he had to perform, his body knew what to do. Guys, that's what simulator is. Get out there, do it, get your feedback, keep it simple. And that's my first hour. And it's the first hour every hour. And then what we're going to do is when we get into the second half, guys, I'm going to click on all the pictures posted. We're going to look at momentum. We're going to look at path. We're going to look at entry. I'm not going to say boo on you or shame on you or I can't believe you did that, you big dummy head. I'm going to say, all right, you told me that because it was red, you wanted to go short. And this is exactly how the feedback works, guys. Let's do it two pictures, two pages. 901. If you put a picture in the room, and this is such a good example, I ask you, plead with you, just do this every time. Have it copy paste. Strong triggers, clear path, entry at area, inside triggers. Just get in the habit of writing that on a chart. So if this was your entry right there, it would have been about right here on the chart. Your circles will line up. And you're going to say strong triggers. And if you're brand new, you might say yes. And if you say yes, I'm going to say I want you to notice something. I want you to notice that those large triggers are still up, but the small triggers are in fact down. But until they roll, you don't have the momentum you need. So your yes was actually a no. And what we're going to do is we're going to turn that into a lesson on momentum so that you can find it. And when you say, you know what, Mark, I had a clear path, I had room to my targets, a lot of times people say, I had room from my entry to get to that fib. But because the fib was already hit, because the triggers were above, you actually didn't have a clear path. You didn't have room to a target because the target already became a termination condition. So you didn't have that. And so that one would be a no. And what it does is it opens the door for a lesson to go back and review termination conditions to make sure you have an understanding. And then, but Mark, I entered at the area inside of triggers, and I'm going to say, you know what? You absolutely did. And what a great job you did recognizing that areas in the retracement zone are the most likely spot for a bounce. But here's the deal, and I'm going to say it like that. Here's the deal. 66% of the things that make a trade great, 66% of your advantages, both of your large chart advantages weren't present. And if you took this trade, this is what we call an avoidable loss. Because an avoidable loss means that you traded without an edge. An avoidable loss means that you deviated from the plan that you had in front of you. And because there weren't large chart advantages, there's no reason to take this entry. And if you took a loser here, it's a loser that is avoidable if you simply follow the plan. So that's what every chart's going to get posted. So do me the honor of annotating your charts. Do me the honor of telling me what you see. Give me the opportunity to help you. Give me the opportunity to give you the feedback to help you grow. I'm going to take 5 minutes. I'm going to drink some water. I'm going to stretch my legs. When I come back, we're going to go into chart reading. I want you guys to post your charts, post your questions. When we're done with all the Nexgen stuff, when you guys run out of pictures to show me, I'm going to shift gears. Appreciate it. I'll take a look at it. Hit them straight, Ron. I haven't golfed up here yet. I need to get a tee time in. When we're done with the Nexgen stuff, so when you guys run out of pictures, I'm going to go to TradingView. And today we're not going to play TradingView Tech Help as much. We're going to talk about some of the basic functions. We're going to talk about how to enter. We're going to talk about how you can move stops. We're going to talk about some very basic moving chart stuff because I know there's some of you that just need that basic functionality. And those are the things that you're going to use as you go in. But until then, we're all Nexgen, guys. I will see you in just a few minutes. Anna, you know I was talking to you, right? I absolutely was. I'll be back in a few minutes, guys. All right, guys, I'm back. So RCH and famous Caleb, are you guys still with me in here? I want you to see something. This is pretty cool. While I was away, you had odds favorable momentum. While I was away, you had a clear path, and you sure enough had a pullback at an area inside of triggers. And right now, it doesn't seem like things are going your way. But from '07 and a quarter up to 1050, that's a moneymaker. It's not going the distance just yet. That's a moneymaker. That's what we've just talked about for an entire hour. And it just happened live in front of you. Morgan is probably going to post the picture annotated telling you what he did and why he did, because Morgan's pretty amazing like that. So we're going to go through and we're going to start looking at some of the stuff going on in the market. Pete got us going. Warm up, trade, and sim. I love that. Man, until the coffee kicks in, it's okay to warm up and sim. And what Pete had was odds favorable momentum, separation between the small and large, and he had that potential to break, that 50-50 look. The small triggers are smashing through. The large triggers aren't quite there. Pete takes a rock star entry, gets paid at the area that could be problematic, and follows it because it's not high probability. So here's that pattern again. This is the 50-50 trade. It is the perfect look, the perfect entry, and aggressive management because it's not a high probability trade. So Pete, I'm going to take your picture, I'm going to liberate it, and I'm going to give it a new life here in my spreadsheet. Because what I really want you guys to do is I don't want you to take my word for it. And I know that sounds weird. I want you to come at me with some suspicion. I want you to do the work. I want you to circle those tails. I want you to wake up in the morning and say, that Novak fella's full of beans. I'm going to prove him wrong. Because if you take the time to do that, true story, if you take the time to do that, you're probably going to be with me for the duration. Most people are. If you take the time to prove the methodology wrong, it means you studied the methodology enough and you're probably going to realize that it's pretty solid. So here's Ron. Ron's no longer with us. He's on the golf course because when you learn rules, you get to the golf course early. Ron says, I want you to look at this momentum. Everything is screaming up on this chart. There's absolutely nothing in the way. So I'm going to capture a little bit of money riding that momentum. Momentum and path has created a trading plan for Ron. It's not a high probability trend trade. Guys, it's not a pullback to an area inside of favorable large triggers. Once Ron understood the high probability trend trade, he was able to say to himself, holy crap, momentum on both charts is hard to stop. And if there's nothing in the way to stop it, I can make 110, 150 bucks a pop. And then just get out and wait for the next trade. That is the trade you're going to hear referenced in this room as the chili dog. The chili dog is not a Nexgen trade. Nexgen doesn't teach it. I didn't create it. I've studied the heck out of it, and I admire Ron for creating it. And a lot of you in the room take that trade. A lot of people gravitate because with momentum and path, it's difficult to not find a way to get paid. Cav, strong top, odds favorable momentum, potential to break, pull back to the area inside of triggers, making money. There's the pattern again, ladies and gentlemen, and this is all from today. This isn't planted people doing historical stuff. Absolutely perfect. Momentum, potential to break, perfect entry, getting paid. That's the goal. The goal is to get paid. For the 17th time today, momentum, potential to break, perfect entry, getting paid. And I want you guys to see something cool. So this is crude oil. Coming from a strong top, the potential to break, perfect entry, making money. That's the NASDAQ. It's the same look. All we're trading is patterns, guys. That's all I teach, is I teach a pattern rooted in advantages, and you can take that pattern and find a way to capitalize, and it's pretty cool. All right, Pete. Weak bottom, strong triggers, and there it is again. Jumped in, of course it reversed on me. Where did you get in 92? Yep, so this is the idea. Pete's like, you know what? With all that momentum, I'm just going to jump in. And the market said, hey, check it out. Boink, boink. But because of the momentum, because of the path, Pete's able to hold. Pete's able to get paid. You learn to trust that large chart, guys. You learn to trust the idea that when your large chart is railing in the direction, when there's nothing in the way, little fluctuations on the small chart become a little insignificant. Jumped in, turns into a trend trade. You add it on, make money on the way up. The market will make you earn it every now and then, right? She's what I like to call an angry goddess. She gives with one hand and she takes with the other, which is why it's so important to respect the patterns, to respect the rules. All right, Pete again. Not a lot of pictures today, guys. Like a freight train. So what Pete's recognizing here, when the market, when your large chart goes 30 plus bars and doesn't give a reversal bar, when your large chart breaks 3, 4, 5, 6 Fibonacci areas, never gives a reversal bar, this is what we call a strong trending market. And a strong trending market, guys, once you get past trouble in a strong trending market, you're looking for trend trades, you're looking for momentum trades, you're looking for any opportunity to capitalize. And that's what Pete did. He let it get above the fibs, jumps in, jumps out, quick $450, get out of the market, because strong trending markets do end eventually, and it's harder to predict retracement, so quicker profits make sense. Great job on this one, Pete. When there's nothing in the way and the market is screaming, you will find a way to get paid. Have I mentioned that? Morgan. Strong bottom. I love this. Let's identify where it's coming from. Odds favorable momentum. The first rule, making sure the advantage of momentum is there. 50-50. Large triggers haven't broken, but the small triggers have. And then, guys, divergence is the biggest killer of 50-50s. I'm going to tell you a story, and it's based on Morgan's chart. This is your 50-50 trade plan. This is how you optimize your chances of success with that medium probability trade. Comes from a strong top or bottom. Absolutely imperative. Increases the chances of success. Odds favorable momentum on both charts, small and large, which means that you have to have separation in the triggers, not only on the large chart, but also on the small chart. You're at the tail end of momentum there, Morgan. The KISS plan says no divergence on the 5-1. Why? Well, because divergence is a loss of momentum. Not having strong triggers on the small chart is a loss of momentum. And the small chart shows change that you can't see on a large chart. And then it reminds you, divergence, no trade, because divergence kills 50-50s more often than it doesn't. And then in management, it tells you again, divergence, no trade. Guys, this is how you optimize your chances of success. Morgan says, because of the strong bottom, I'm going to take a shot anyway. I've adjusted my trading plan based on the time that I've spent, and he's willing to take this trade. And it's a perfect entry. But it still failed. Didn't have momentum in the triggers. Divergence is a loss of momentum. 2 indications that this is less likely to win. And let me show you why. This is my favorite thing to do. Maybe not my favorite thing. I'd rather play golf. But in regards to trading, teaching this class, this is why we talk about advantages so much. This is why I am so broken record about advantages. Because if you open up this picture and you write that very simple recipe for a trade on the chart, momentum Momentum on the large chart, perfect. Check that box, right? I have momentum. That's awesome. Because it's a 50-50 trade, because the large triggers haven't broken through yet, because you're speaking of advantages, you're gonna say, whoa, I don't have a clear path. 33% of my advantages have now gone away. I've got 2/3 of what I need to take a trade. Entry area is perfect. You've got it. You're there. So this is what you're up against. This is what you're up against in the trade. You have momentum on the large chart. You don't have a clear path, and you have a clearly defined entry area. Because I don't have a clear path, there's things that I want to see. The first one is I want my small chart triggers to look like this. So Steve, this is exactly what I'm talking about. I want this look on my large chart to be the exact same look on the small chart. Because what does it mean when the small triggers return to the large triggers? It means momentum is slowing. Does that make sense? So I just lost Mo. With weaker triggers, I don't have Mo. So now I have momentum in an entry area. Divergence is a loss of momentum. So my momentum turns into entry area. Two signals that the market is slowing down. It takes momentum to break an area. And if you're in tune with the idea of I'm trading 3 advantages, you'll begin to see that change on the small chart and realize that this area is less likely to break. Morgan did a good job with it. Morgan knew why he took the trade. He explained why he took a trade despite divergence because of the strong bottom. But Morgan also had realistic expectations. He's sacrificing 2 of the things that make this trade great. There's only 4 things that make it great. It's got a 50% of his advantages, 50% of them are gone. Does that make sense? Morgan, does that make sense? I know you're willing to make the exception because of the strong bottom. But for you guys that are working through the idea of why is talking about advantages so important? Why is referring to the strong triggers, to the momentum, understanding that key concept for the high probability sets you up for success on the medium probability trades. Did I already see these? Yep, we did. I hope that's helpful. Just as the previous chart, sometimes you sacrifice a bigger move with a trailing profit stop. More often than not, it saves you for this. The name of the game is to actually make money. Amen. Pete behind the pulpit. Pete behind the pulpit. Morgan, those 5-1 triggers are hugely important. That's why I put it on the checklist for you. But that's the most ignored part of a 50-50 trade. Right on. Let it be black and white. So check this out. So dig this, Morgan. Strong trending market, right? We assume odds favorable momentum because it's a strong trending market. Does that make sense, everybody? What do your small chart triggers say? Say we're losing steam. The smalls are inside. Anything can happen. Weakness. And what happens? The market pushes down. So be in tune with momentum, guys. And remember that the momentum look on a large chart is a momentum look on a small chart. But when you have odds favorable momentum and a clear path, and you take the perfect entry, and your stop's in the right place, you're going to make some money. Morgan, great recovery. One of the hardest things that you'll ever do is take this trade and lose and believe you had everything right. And a lot of people skip this one because it looks familiar. So go back to those very basic things. Odds favorable, clear path, perfect entry, and you made it back, right? You made it back. And now we're break even and we're focused on the best of the best so that we can continue with that. Odds favorable, clear path, separation between the small and large. You take the pullback to support right inside of the triggers, and man, that one didn't work, Joel. But you did have a reversal bar to put your stop behind. That's about the only thing I can give you. I like the look. The market's going up, the momentum's there, you didn't hit it. If you had gotten in on the first push, that reversal bar makes this like a 2 or 3 tick loss. But because you second guessed it and you caught it after it tried to go up and couldn't, they just didn't have anything left. And this is one of those times where you might take the perfect trade. And that commitment to the entry, not missing the best entry, makes it even more manageable. It's a good look, Joel. It's a great read. Just caught it on the wrong bar. Good stuff, though. It's a great look. That's what Sim is for, right? Oh my gosh. Guys, I have gone thousands in the hole on Sim. Oops, I lost my NinjaTrader. Whether I'm testing new patterns, whether I'm testing management, um, where I'm looking to see if can I find exceptions to the rules to maybe change my trading plan. You're all going to go through that. You're all going to go through that idea that I'm done with a high probability trend trade. I'm done with waiting for momentum path and entry. I want to find something else. I want to find a different trade. I want more trades. I don't like sitting still, or I don't think the high probability trend trade happens enough in the hours that I have to trade, so I have to find something else, and that's okay. And Nexgen has things beyond the high probability trend trade. Lost 5K in sim learning. Yeah, that's it. Cav, I agree. Stick with the rules and you can't go wrong, no matter what the rules are. So one of the things is we have an HVA trade. It's right here in the user guide, everything for you. But I want you to see something. So the Nexgen's market flow high volume area trades. The first rule says a good top or bottom, which means that no triggers get through a Fibonacci area. This is the lesson that you learned as you learned the high probability trend trade. And it says no termination conditions. You have to have room from your entry to a target. And that's exactly what you learn in the high probability trend trade. And then you've got to pinpoint your entry. And your pinpointed entry is right at an area that involves triggers, which is exactly what you've learned from the high probability trend trade. So what's cool is once you get that first trade, you understand the concepts that'll take you to the next trade. There's also a momentum trade, and it starts with that darn termination with no triggers get through, and it includes the no termination conditions. And guys, entry at the area and triggers. Holy crap. I could be talking about a high probability trend trade with these rules, but what it is it's a different pattern. So the momentum trade is a pattern. The HVA trade is a pattern. The high probability trend trade, ladies and gentlemen, is a pattern. That's all it is. Caleb and RCH, I'm not sure how old you are. I'm sure you're younger than me. But if you remember in the 80s, whoa, there it is. Look at that. Potential to break, area inside of triggers. Odds favorable, clear path, area inside of triggers. Egads, I love this stuff. Back in the 80s, ladies and gentlemen, you could, in the 1900s, you could take a quarter and walk up to a Pac-Man game. And you could follow a pattern. You could follow the correct sequence of up, of down, of go through the tunnel, come out of the tunnel, go left, go right. And if you followed that pattern, the ghosts never got you. It was like this algorithmic thing before algorithms were cool. And you could do the same thing, whether it was Pac-Man or Space Invaders or Galaga. And there were these patterns that you could follow that could make that quarter last for hours, which pissed off the other 12-year-olds behind you. But it was fun for you because you got to stay in the game and hear the noises and see the lights flashing. Trading is very much like that pattern in the video games. When you stick to it, when you follow it, when you embrace it, what happens is you find success. Jen, you said you did not take this high probability trend trade. Jen, I had you on such a pedestal. And now we got to go the other direction. You ready? You told me that you didn't take it. Oh, did not take this. Oh, it's not high probability. Why not? Well, there's a little bit of momentum, right? It's the beginning. And it's not a clear path. I'm sorry, Jen, you're still on a pedestal then. So it's the beginning of momentum, but it's not a clear path. And guys, that's not a very easy to define. This is the retracement zone, which means that Jen would have a ridiculous amount of risk on a trade that doesn't even have a clear path. So Jen said, I'm not taking it. I'm sorry, Jen. It's not the high probability trend trade. And what does it do? It goes down without her. And Jen says, dag nabbit, it just wasn't my money. Are you cool having missed it, Jen, or do you have remorse because it went down without you? We saw a great example yesterday. No remorse at all. Where it was either a lady or a gentleman, I don't remember, but in the room yesterday, they took the exact same trade. It had momentum, it was coming from a strong top or bottom, and it was directly into a termination condition. One of them, they were able to get paid on. The other one, they lost. And we presented the question, which one was right? What was the difference? Guys, there was no difference in the look. It was 100% the same. And the lesson from what we saw yesterday was that these rules aren't based on the one trade. Guys, your trading isn't based on the one trade. It's based on a sample. There's got to be 20, 30, 40 trades where you take it into a termination condition. And what you're going to find that out of that 20 trades, you're losing 60, 70, 80% of them, which means that there is no advantage. And that means that you have to accept that 20% of the time, 30% of the time, it's going to go anyway. It's going to run without you. It's going to, and you're just going to go, son of a bitch, I wish I would have broken my rules. But your rules aren't the one time. Your rules are the accumulation. It's the sample. It's the odds are in my favor. There's no clear path, Jen, and it doesn't have a termination condition. So from 2004, the fib has to hold. Then the triggers roll. Then you take it. So the first rule from that one's even not met. Guys, this is where, and I'll show you exactly what happened. You ready? I'm going to give you the textbook description of what happened in this situation. Right here, right at that high tick, the buyers said, F it, we're done. The sellers said, okay, we'll take over. That's it. That's all that happened. The people that control the market, one side quit fighting and the other one pushed hard. There was no way to predict it. There was no pattern evident to where we could have just said, yes, I see it. Hell, they didn't even give you a divergence, Jen. No indication that this market was going to do that. But strong trends end. And I think when you begin to accept that you accept that you'll never know what the market's going to do, well, is it 2 ticks? 88, 90, 91? So Jen, let's make a judgment call. Because fibs are areas, right? And Jen, I'm going to get into this, and I may go further than you need me to. This is for everybody. Your fibs, I love this picture. I love all my pictures, it turns out. I'm a lovey kind of guy. Guys, this is how fibs are born, and I think this is amazing, and I had no idea my brother was this smart. So when you open up your software, what it does is it measures every swing in the market, every up, every down, every pivot. And it creates all the different retracement levels, alternates, projections. And there's tens of thousands of calculations and lines that go into this. And then an algorithm kicks in. And this is what my brother came up with, is this algorithm, it begins to weigh them and it begins to sort them and it begins to classify them. And what it does is from these thousands of lines cluttering up a chart, you get Fibonacci resistance, you get Fibonacci support. So they are very much areas. They're very much areas, Jen. And my thought is that if I'm in a long position, that's usually my range where I want to get paid, a tick or two below it, because I know it's areas. And if I'm looking for a termination condition, I may use the same concept, 2 ticks, 3 ticks. But Jen, there's some context clues that I look for if it doesn't quite hit the area. I'm looking for at least one loss of momentum close to that area. I want some indication that the sellers are fighting, and there was none, right? I want to see I want to see 2 divergences, and that helps me at least feel like there's going to be a push down. 3 divergences is even better. And this is one of those cases, Jen, where we never got it. It literally just hit the brakes and boom, done. So show me the same look with 2 or 3 divergences, and let's see if we can find it. The market's going up, everything's up. Well, there's a divergence, right? It's slowing down in the middle of nowhere. I can see it on 2. So nothing on the range chart either, huh? Down at the bottom, the potential to break was there, but look what the small chart's telling you. Hey, Jen, check it out. We're slowing down. We're doing it again. This one might not work. And then the triggers roll, and then it gets above, and things start to change. And now we're above. And even though you might have thought it was going to go down more, it certainly didn't. And that was coming from a range-bound market. So your small chart will give you some context clues. Absolutely it will. And you just didn't get any on yours, which is rare. Yeah, you're welcome. Does that make sense? And then this is a weird trade that required a lot of patience. Market reversed from nowhere. Pete, you're at the beginning of momentum, but it's everything is above fibs. Synthetics haven't rolled yet, and this was a strong trending market. And guys, this is an aggressive short. Pete, this is a crazy aggressive short. Your large triggers are still up on the large chart. None of your triggers are through the areas here. Pete says, I'm going to take a shot. I'm going to take a shot. And Pete, I need you to take one on the chin for me for the sake of the class. Guys, I don't care about your $1,900. Until you're sending me checks because you think I'm a neat guy, don't focus on the money. How many times is this trade going to work? The market just railed up 100 points. Every trigger is above support. The large triggers haven't even rolled, right? Maybe 20%. Pete's probably at the point in his day where he has a little left over, and if this doesn't work, that's cool. But I can't imagine getting in at 59 into all the termination conditions after a strong trending market and being willing to hold $1,200 worth of risk to stay in this trade. And Pete had a cushion because Pete's been following his plan all morning and making money. And that's kind of the difference. This is low probability. This is aggressive. And he's adding on to a trade that's failing in the moment. And Pete, I love that you got paid. Every now and then you take a flyer. Love it. Hey guys, I'm not beating Pete up for taking it. Pete knew why he took it, right? Gutsiest move I've ever seen. Is that Top Gun? Top Gun. I love movie references, guys. And sure enough, it did go down, right? It went right to the termination condition. And now we're in a holding pattern. So I think that's all the pictures we have right now. There's a termination, created a huge bounce right to a termination, closed the gap to the large triggers, did a little dance, and now we have the potential to break on the way down. So I have my strong top, I have my potential to break, I have my area inside of triggers. The only thing that I need to remind myself of is that if divergence prints, that could kill the trade. So I'll put my limit order there because it's just below the area inside of triggers. But if divergence prints, my rules aren't met and I have to cancel that order. Does that make sense, everybody? This is a medium probability. Strong top, odds favorable, potential to break, area inside of triggers. The recipe is there. The only thing I need to make sure is that divergence doesn't print. If this negative number turns into a cyan line, I have to cancel. Oh, no divergence. So if they come get us, we're going to enter a medium probability trade, guys. Uh-oh, I need to put my KISS plan on. If they come get us at the area in the retracement zone with the potential to break from a strong top, we're going to trade the KISS plan. Our stop will go 4 ticks above 98. So our stop will be 99.25 if we get an entry. There it is. Stop where the market shouldn't go. First target is $100. Second target is $200. I am powerless at this point. It's either going to win or lose. I don't get a vote. If I get a reversal bar, then I will move my stop 2 ticks above the reversal bar. If I never get a reversal bar, it means they're coming to get me. Is everybody with me so far? This is what it looks like live in a medium probability trade, not a high probability trend trade. I don't have a clear path. And you're going to watch that small chart dance, guys. You're going to watch it go up, down, up 50, down a quarter, up a nickel. And oh my gosh, they almost went to where the market shouldn't go. We'll see what happens. I'm not in control of what happens. Whoop, there they go. Medium probability trade failed. That's it. Did I follow the rules? So here I go. This is what I'm worried about. Did I follow my rules? So I'm going to take this. Caleb, I hope you were watching that one. Because you asked if the rules will be met and we still take losers. So, did I come from a strong top or bottom? Yes. Did I have odds favorable momentum? Yes. Did I have smalls outside of the large on the small chart? Yes. No divergence on the small chart? Yes. Enter at the area. Divergence, no trade. I took the absolute best look for a medium probability trade that you could ever take. It didn't work. What am I going to do? I'm not in control of whether or not it works. The only thing I'm in control of is following my rules. So let's back up just a notch. Odds favorable. Clear path. Perfect entry. Easy money. What's the difference? The difference is I had all of my advantages. So in the morning when I tell you guys the easiest money that you will ever make is with momentum and path, I mean it. Study it, learn it, commit to it, embrace it. That's going to be what gives you the highest chance of success. Sometimes the medium probability trend trades will work. Sometimes they won't. This is a pattern that's been proven to win 70 to 80% of the time. And when it comes from a strong top, it feels good. Does that make sense? I say, does that make sense a lot? This is it. This is your money, guys. This is the easiest trade you'll ever take. Did anybody take this on the S&P? Do I have any S&P traders in here? Because, oh my gosh, warm fuzzies. Warm fuzzies on this one. It takes $400 a day to put you in a 6-figure income. What if it takes you 6 hours in front of the computer to capture that $400? Probably 7 or 8 minutes of actual work. 5 hours and 50 minutes of playing solitaire or drawing pictures, worth every penny, right? How long does it take you to believe that, Kev? That's my thing. How long does it take you to believe that you can build a career off of one pattern, one look, one market? I don't know. No, Steve, it was perfect. Everything about it was perfect textbook straight out of the KISS plan. I had a strong top. I had a termination condition that reversed the market. I had odds favorable momentum. I had it on the small chart too. Do you see it? And I had an area inside of triggers. I had everything that I needed to believe that this one had a shot. It didn't work. So I have one choice. Well, I guess I have two choices. I can cry about it. Or I can say next. Next, let's wait for the next one. Jen, they did, but where were they when the pullback started? I had odds favorable momentum. It won't get to my entry if these don't roll up. I want to see where they're starting. At the time of the reversal bar, do I have the strongest momentum ever? I know that these are going to roll up on a smaller chart. That's the only way I get to my entry area. Does that make sense? It's where you're starting. Good question. I like that comment. So now I say next. That's it. I lost one. Dust off. Go to the next trade. But the reality is that if I keep catching this bad boy and making money, I don't care. I'm going to take losers. I'm cool with losers. Losers happen. All right, Better Dad, let's see what you did. Better Dad says, Mark, check it out. It's a weak top, and it is odds favorable momentum. And it's absolutely a pullback to a mid-band inside of the retracement zone. Pretty big stop with those triggers up there, but it makes sense. Easy money. Better Dad. Perfect. Pete. Termination condition. Back to more sensible chart reading. Way too much risk. Risk is not worth it. Rules aren't met. I love it. You know what, Morgan? That's a great question. I need you to write Chris Novak an angry email. I'm going to mess with him real quick. I love my nephew. He's amazing. If you guys had any idea how hard he works to make everything perfect. So Uncle Mark is going to give him a little hell real quick. And I just posted that picture in there with a big, where's the little laughy face? I don't want him to think I'm beating him up. No, you didn't. So Chris has, oh my gosh, he has done unbelievable work going through, rebuilding everything, all the resources, all the review. I mean, everything. That kid has killed it. I say kid, he's in his 30s, but I remember when he was born. He's done the same thing on this one, and this one looks like it's still being worked on a little bit. But it's not there. So Trading Guides is there, but he's talking about the software guide, Better Dad. That's the one that talks about all the ninja stuff, all the how-to. And during the rebuild, it accidentally got left off. So trying to rebuild all your workspaces, Morgan? Is that right? You're just trying to get... No worries. So you're going to go to Documents, NinjaTrader 8, Workspaces, and you are going to delete all of these. Whoa, that's some big font. Hold on. So that's going to be the first step. And then you're also going to go to NinjaTrader, Templates, and then go to Chart. And you're going to delete everything in here. There you go. And that's going to get all of your charts, all your workspaces gone. You have to do that. Yeah, no worries. And then once you do that, all you have to do is go back to the website and go to resources. Hopefully I can find it. Shit. That's not it. Resources. And I don't know where they put the indicators. He said if you go to trading guide. Oh, there it is. Check it out. Software guide. Found it. Oh, thanks, Chris. There's the software guide. And where is the one where you download indicators? It's usually in resources, community, affiliates, reviews, trading guides. Sorry, guys. Sometimes things are under construction. It's probably someplace really obvious for me. Flagship edition, how it works. There it is. Golly, that's not easy to find. Okay, you did find it right there. So here it is, Morgan, on this one. Right there, download Nexgen indicators, access software indicator packages. Right there. So it's actually in the first one. Cool. Got it. I like it, guys. He does such an amazing job with this stuff, but I'm old and I'm used to finding things where I see them. So you're set. You're set. All right. Is that it? Did we get through everybody's pictures? Joel gave us one. Joel says, check it out. Odds favorable, potential to break, strong triggers, perfect entry, didn't work. That's it. That's it, Joel. You followed the checklist perfectly. You just got one. No, it's okay. This is what class is for, Morgan. Class is for you guys getting the answers that you need. Class is for you guys being able to do what you need to do so that you can find success. Sometimes that is going to be giving you a little bit of software help. And I'll always do it if I can. There's a directly into a termination condition. Didn't work. Thank. Cab just absolved you of all wrongdoing. Cab's good like that. All right, guys. I'm going to take 2 minutes real quick. When I come back, I'm going to go through some TradingView basics. I'm not going to go through how to set it up, all that sort of stuff. I'm going to go through entering, through exiting, how to scroll a chart, like the little things that you need to be able to get in and start practicing this plan. If you still don't have it set up, but you want to get it set up, here's your instructions, guys. I encourage you to read them all the way to the end and get your stuff set up. So what I'm going to do is I'm going to go through some more mechanics first. When I'm done with mechanics, if you want to throw those setup questions in, we'll do it. For those of you that are new with me, this is TradingView. This is another platform that Nexgen has written indicators for. This is going to be a great opportunity for people to be able to use our funding company. This is not the new stuff. This is the same stuff on a different platform. This is not an alternate to the software that we sell. This is a different version, something else for people that are using a different platform. There's over 60 million users on TradingView. We wanted to make our methodology accessible to that platform as well. Um, in order to get Nexgen indicators, I believe you have to have a license for Nexgen to get them for the TradingView platform. So, guys, it's not new or old. It's not good or bad. It's not fresh or stale. It's just, I put on a different shirt. That's all it is. I'm the same guy. I just look a little differently. So there's your instructions. And I'll be back this way in just a minute, guys. So go stretch your legs for a second. Back in a few. Here we go. Jared, I got your test loud and clear, man. Welcome to the room. So guys, I'm going to pull up my trading view real quick. And here's what I did. I'm going to get rid of all of the indicators. We're going to go one chart. We're going to try and make life easy here. Some of the first things that you'll need to know, just scrolling and scaling, guys. If you click on your chart, you can move it anywhere. You can go forward, you can go backwards. It is 100% attached to that little clicker mouse. So if you wake up and it's gone, there's two things you can do. You can keep doing this and try to find it, or you can right click on your chart and reset the chart view, and that's going to put it back to its default. This is your price line, this is your timeline, just like you're probably used to. You can stretch it out if you want. I prefer to have mine a little more stretched, that's just me. You can go vertically as well, and you can recenter it like this. You can also come down on your price line, and that A will put you in the center and keep you centered. Had some Nexgen users teach me that. So basic scaling, that's kind of it. It's not difficult. It's literally click and drag. When we talk about entries, because that's what I was like, well, Mark, how the heck do I enter? This is the first one. So these buy and sell buttons, these are buy and sell now. It's not a limit, it's not a stop, it's literally let me get into the market. You'll use this for trend trades, waiting for that close on the correct side of the triggers. That's typically where I use it, is for those trend trades. So let me give you guys this, and let's go through the buy and sell now. And this will be in the video as well. So let's say the market's going up, my rules are met. This is my contract. Hey, John Novak. So this is my quantity. Right now I'm 2 contracts. I can make it go higher. I can go down to a 1 lot, whatever I need to do. If I hit buy, it's going to put me into a position. And you can see where I entered. You can see where I'm at in my P&L. Whether I'm winning or losing. You've got take profit, and you'll notice that it shades above it. So take profit is where your target is. You can just click it and drag it off to the distance. And then your stop loss is where you're giving up, where you say, okay, this is where they're going to have to come get me. And you can literally just click and drag those. It's so easy. There's not a traditional ATM strategy. It's really going to be more of a, this is where I want it to go. Let me put my target there. This is where I want it to stop, where I don't want to be in the trade anymore. Let me put my stop loss there. So far, so good. We are long 2 contracts. So let's say you're like, well, I've got some trouble in the middle there. I'd love to lose one of these contracts at trouble. You're going to have to change your quantity down to 1. And then over to the side, you're going to click on this plus, and you're just going to sell 1. And now you've got a partial that'll take one of the contracts off. So if it comes up and hits that partial, you've sold 1, and now you're in the market 1 contract. If you want to get out of the trade, all you have to do, close position. Click the X. That's going to be your very basic. That's going to be your I'm going to get in because of a close on the correct side of the triggers. I'm going to get in with momentum, and I just want to get into that trade. These are going to be your buy and sell nows. The other option is what you're used to on the traditional trend trade, is activating a limit order. So if I want to sell the market with a limit order, I'm going to have to click above price. So I can right click, and I can go to, where did it go? There it is. Sell 1. So wherever I clicked is where that sell limit's going to go. And it's up here. I don't know if that's where I want to get in. So I can drag it to where I actually wanted to enter the market. Now I've got a sell limit in place. The market has to come to me for entry. If I want to buy the market, I'm going to do the same thing below it. I'm going to right click, buy one, and now I'm going to put it where I need that retracement to come. Guys, you're going to use these for HVA trades, where you're buying or selling that pink or green line. You're going to use these for momentum trades. When it breaks above an area and you want it to pull back to that area to find your entry, you can use these limit orders like that. So far, so good. And practice it a little bit, right? So go to one of your charts that has the indicators on it. Whoops, and say to yourself, okay, this is going up. I want to buy this HVA line. I'm going to right click. I'm going to put a buy limit. Whoop, I'm going to have to be in paper trading. I'm going to right click. I'm going to put a buy limit too. And if they come back, it's going to get me. And John is long on the NASDAQ. Yeah, I missed the long, John. So we haven't talked about trade types yet. And I don't know why you did what you did, John. Why did John go long here? Well, his large triggers are up. His small triggers are up. He's got everything hidden behind his stuff. The market tried to break above, pulled back to the zone, and he gets in on the way back up. Maybe a little early, little anticipatory. Once you close above those small triggers, that's where it becomes easy. That's where trading with trend, trading with momentum, that's where it becomes easy right there. So are there any questions about the buy or sell? Any questions about activating a limit order? Any questions about being able to get into that market with a quick tick, putting your stop loss wherever you want it, putting your profit target wherever you feel like it's necessary? Ooh, I haven't seen a Long John Silver's commercial in 40 years. And Dima, is TV by itself enough? Yes. Is it better to use it with Ninja? You can. I love it. I like NinjaTrader along with it. And this is what John is doing. His entry was somewhere right around here. His targets are right up here at the 1-to-1. So you can use both of them. Absolutely. Do you have to? I don't think so. I like it. I use both. I love Fibonacci, guys. I'm such a big fan of Fibonacci. I've been doing it forever. So I'm a fan. But let's go through what John did. His large chart says up. His large chart has momentum. Price gets above the trouble area, pulls back to the trouble area. John Novak goes long. That's it. Pretty simple. And there's his entire workspace. And I still say, you've got your charts reversed. Mine looks exactly the same, except I do my trading view on my right monitor and my NinjaTrader on my left monitor. Guys, mechanics is a big part of being able to be comfortable, being able to get in. What are some other questions that you guys have about the mechanics? Anna, what else do you have going on? Yeah, and my front middle is Ninja. And my right screen is Trading View. And clearly that's the best option because that's the option that I use. So sibling rivalry. Good stuff. Guys, what have you been wondering? Gary, did you get those lessons? Those are the ones you were asking the other day. Did that help a little bit? It's easier, I think, to go through the mechanics a little bit without all the indicators because then you're not thinking about a trade. You're just thinking about learning how to use this a little bit, make it a little more comfortable. And then once you understand that, right? Once you understand that, that's when you're going to start practicing. 5 monitors. Whew, that's a lot, Diva. So Jerry, you can click trade, and before you ever enter the market, you could set up your take profit, you could set up your stake, your take loss, your stop loss. And guys, this is one of those things, whichever one appeals to you. Jerry, the time it takes me to go through and do all this, it's easier for me to just stamp that button and drag. That's just me. But you can set them, absolutely. I find that I would rather just click and drag. I'm a minimalist. Yeah, it's two ways to the same goal, without a doubt. And some of you being able to see that first is appealing because once you click take profit and stop loss, you're seeing visually exactly where you want it. And then if you do buy the market, it all comes into play. And you can still move them if you need to, which is pretty cool. And then close out. Changing workspaces. This is it, Anna. From NASDAQ to S&P to crude to gold to XRP to our taste. That's it. That's all you need to do to change workspaces. Is just a new tab. And then adding indicators. You're old and on drugs. And you can, Jerry. So Anna, adding indicators. I'm not sure why you want to add indicators. So the workspaces are pre-built with everything you need to follow the plan. If you want to add indicators, all you have to do is click indicators. And if you search them, maybe you want, I don't know, what's an indicator that maybe you want to, I don't even know what it is, stochastic nest, right? I click on it and it adds it. Triple moving average, double secret probation. So what happens is all you have to do is click on these indicators. These are the Nexgen indicators. These are the chart primes, and they're under invite only. These are the ones that I've deemed my favorites. These are the ones that I've created myself. Here's a lot of technicals, indicators, strategies, profiles, patterns, financials. There's so many different things that you can do here. And it all just starts with clicking indicators. So if you feel like you need to add an indicator, feel free. But your workspaces are going to come built with everything on them that you need. And then John says, check it out. I hit a zone. And because I hit a zone, no more longs, right? Isn't that like the easiest way to say it? I hit something that could stop the market. I see it. I recognize it. I choose not to trade into it. And then Dima, is there any way to predetermine stop loss? We just did that with Jerry. So if you click on trade before you enter, you can set it up here. So when you're ready to take a trade, you can put in your profits predetermined. You can put in your stop loss predetermined and then enter the market if you want to. No, it's okay. No worries. And what you can also do is order presets. I could call this one buy. So instead of having to go through and do all this and set it up every time, I can just go through and click my buy preset. Uh-oh. Can't be used for this symbol. Maybe I set it up another one. But yeah, that's it right there. So you'll know exactly what you're getting into and where you're getting out. And what's cool is until you buy, look how they shuffle with it. I think that's pretty awesome. And then once you hit that buy, then they become a little set in stone. And then like Jerry said, if you're in a long position and you want to exit, you could also just mash that sell button. And that'll take you out of the position as well, which is pretty cool. Can you add lines on the charts to match? So like, oh, thanks, Jerry. I appreciate that. I've heard that more than once. I hate my voice, so I think it's interesting that people do that. So over here on the side, Miss Anna, these are your drawings. So if you go to the paintbrush, actually the one I like to use if I'm going to do fibs is I will take this one right here, the trend line, and And let's say I'm looking at my Nexgen chart and I have a fib at 2180. I'll just draw it in. I'll take that and do a horizontal line. And now I know without question that my green dashed line is a Fibonacci spot on my Nexgen chart. So if I pull up the S&P, let me get my large chart. 58.18, I knew there was a big ugly fib. 58.13, I know there's a fib. So I can go to my S&P, and at 58.18, I put in a fib. And now I know that there's a little bit of trouble there. Good question. So you can do that all day long if you want to set up, do a little pre-market before you get going, and have those in place. And then just when you're done with them, you can just get rid of them. And the cool thing is Nexgen has fibs that are red and blue, but the rules for breaking and holding are the same. If price reaches them, it sets it off. And then if price breaks it, stuff like triggers break it, you know that support becomes resistance and resistance becomes support. So the color becomes a little unimportant. So make it any color that appeals to you. All right, Caleb, let's see what you have. Woo, there's a lot of lines on here. I love it. So Caleb, I'm going to give you the keys to the kingdom right now. Are you listening? You're going to dig this. Every time you take a trade, get comfortable writing on your charts. And I'm going to write three things. I'm going to write strong triggers. I'm going to write clear path. And I'm going to write entry inside of triggers. Awesome. Anna, by Sunday, assuming your drugs aren't too terribly strong, by Sunday, you're going to be very, very comfortable with this. Inside of triggers. Caleb, I love what you did here. The background is green, the trend is up. So there's your first advantage for a long trade. Smalls are above the large, everything's green, space between. You have the advantage of strong triggers. Already off to an amazing start, recognizing the momentum. And this is where things go a little bit sideways. This Fibonacci area. So the one thing that we want is we're going to go back to that idea that if price reaches this area and the triggers haven't broken yet, then it's what we call a termination condition and you don't have a clear path. If your smalls get above it, but the large are still below it, as long as there's momentum, it still has the potential to break. And with this momentum here, great opportunity to come back up and test it. But what you're seeing is divergence, which is a loss of momentum. You're entering at the areas. You've got rule 3 concept down. So the only challenge on this chart is rule number 2, the idea of a clear path, of making sure that you have room to your profit targets. So let me go back. I love this. 2 or 3 days in the room and you're already picking out these trades. That's what we want to see. And then it takes a little bit to really get good at it. But let me show you this one, if I can find it. I like this picture. This is an old picture. And it kind of goes through the 3 options. So first, with no triggers through, the area is not broken. You were able to move past that one. You were at the look where it had the potential to break, where the smalls are above, where the large are below, and that momentum says that it has the potential to break, and that's exactly what you were looking at. And then the smalls above and the large above, that's when you have a clear path. So a little bit of study on these is awesome. And then if we go back to your picture, what you're going to see is that we didn't quite have that clear path, but the potential was showing up. And since rule number 2 is not met, this divergence lets you know that you may not have the momentum you need to break that area. And this would be a no trade situation. I love that you're in there pulling the trigger and throwing these things out and talking to me about it and giving me the opportunity to see it. And I promise you, every trade you drop in this room, we will go through it top to bottom, and we'll continue to do this until you're as comfortable as you need to be. David, thank you for that. Vittorio, there is not a traditional ATM like you're thinking of in NinjaTrader. Um, Simulation mode is paper trading. So let me log out of paper trading real quick. When you open your chart, you'll go to trading panel and you're going to click on paper trading. This is simulator. You'll connect and now you're in paper trading. And Miss Anna, you'll know you're in paper trading because it'll tell you down at the bottom. You are paper trading. If you were live, if you were in your AMP account, you would see AMP right there. You would see whatever your broker's name is. So as long as you see paper trading, you know that you're in simulator. Did you get that one, Vittorio? And then when you talk about an ATM, guys, there's not a traditional ATM. There's not a let me set up stops and targets. But what you can do, Vittorio, is if you click on trade, you can set up your profit targets. You can set up your stop loss before you ever enter the trade. So if I wanted to go short, I would click sell. This is where I want to get in. This is where my risk is. This is where my profit is. And then if I click sell, everything is active and in place. So it's not a traditional ATM, but you can know exactly what you're getting into before you ever get into it by using that trade feature. And then if you want to exit the trade, you can click buy because it's the opposite of sell. If you want to exit the trade, you can close the position right here. You didn't? Okay, so let's go back to it, Caleb. So there's three things that we look for in a trade. So when you took this trade, Caleb, the one thing that I would ask, the one thing that I'm curious of is why did you take it? So what made you feel like you wanted to go long there? And I know that that seems like a pain in the butt to have to tell me that, but when I know what you're thinking, it makes it easier for me to help you with all the lessons. So I had to guess. And this is crude oil, right? And this was right around 61.75. So let's do this, Caleb. I hope that you appreciate this. Right here at 61.75. I'm going to break it down without all of those arrows on here. So the first thing that we look for is momentum. Are you with me on that? Caleb, rule number one says that we must have strong trigger lines. Okay, so watch this. I'm going to show you something cool. I'm going to take every indicator off of this chart with the exception of trigger lines. And what we can do is we can make sure that rule number one was met. So at your time of entry, which was right here, we can say without question, without hesitation, Caleb, rule number one was met. Do you see it? Small's above the large, the separation. So 100%, you followed rule number one. This is a great recognition of that first advantage. Are you with me so far? Don't even need the entry chart yet. Awesome. So now I'm going to put areas on this chart because that's rule number two, is making sure that we're not trading in determination conditions. So when we talk about areas that could stop the market, and we're going to do it, the circle is where you took a trade. Just so you know, so that actually I think you got it right here. So when we talk about termination conditions, rule number two, areas that could potentially stop a market, there's a recipe for identification. And that recipe is consistent 100%. So in order to define a termination condition, let me find my picture here. Anytime price reaches one of those lines, Caleb, you're going to use the trigger lines to determine whether or not it is a termination condition, meaning that none of the trigger lines have broken through, whether it has the potential to break, meaning that the small triggers and the small triggers have broken through, but the large triggers have not, or whether it's a clear path, meaning that the smalls and large have gotten above trouble. So there's three options every time when you're looking at a termination condition. It's either going to be that textbook termination, and that is price reaches the area, none of the triggers break, not a clear path. The potential to break, smalls get through, large don't, or an actual clear path where the small and large get above. So these are always your three options anytime you're looking at a trade. So we're going to go back. Do you see how the small triggers are through the area, but those large triggers haven't come close? At the same bar, the same time where you're looking to take that trade, the smalls are getting through, but the large are kind of waffling. They haven't made it. They're lollygaggers. They're still below the areas. Can you see the look? Remember, we're doing all this on the most current bar, the first bar. And I love that you're asking these questions. This is what makes this classroom amazing. Do you see how the smalls are above resistance, but the large triggers are still below? So we call this a 50-50 look, Caleb. 50% above, 50% below. And what that 50-50 look means is that because of the momentum in the market, these Fibonacci areas have the potential to break. So now we're going to open up the small chart. And your small chart was right about here as you're making the decision to take the trade. And if I'm not mistaken, your first entry was right here. And your second entry was right here. So what I want to do is I want to celebrate some stuff. Your first entry, Caleb, you had momentum. The potential was there to break. And let me draw it out. Rule number 3 says pull back to an area inside of triggers. That's your entry. So this is the entry rule. And this was your first attempt. And it absolutely pulled back to an area inside of triggers, which means that you're starting to understand this concept. And you even took a second shot at it at the mid-band because it's still a pullback to an area inside of triggers. And once again, you followed the rules beautifully for entry. And you followed the rules amazingly for momentum. And the one thing that got you, Caleb, was that second advantage, was that clear path. You were taking a trade where the market only had the potential to break. And that's the second trade on the plan that we teach. And the one requirement to give you the highest chance of success for that entry is that you don't sacrifice any momentum on that small chart because it takes momentum to break areas. And what this divergence is a loss of momentum. And what these small triggers below the large triggers is a loss of momentum. See how there's a separation, strong triggers here, and the market continues up. And then with weakness 2 times, it's having a really hard time breaking that area. That's actually the second trade in the trading plan. So where you're at, based on what you just showed me, is you completely understand momentum. Momentum is easy for you. You nailed it already. Awesome. And you clearly understand the recipe for entry, looking for those areas inside of the triggers. So your point of focus would be to go back and revisit the idea on termination conditions, that in order for it to be considered a clear path, both small and large triggers must get above that Fibonacci area. And then your path remains clear until you hit the next area. So you can see it here. It's trouble, clear path, it's trouble, clear path, it's trouble. And this repeats itself all day in all the markets. And what you're going to find, and let's go back to this picture, that what we teach in this room, what I teach in this room every morning, is the idea that if you have those strong triggers And that if price isn't trading into one of those areas, this is the easiest, highest probability money that you can really make with the software. Does that make sense? Did breaking that down a little bit? One thing that I've learned teaching this for the last 5 years is that everybody hears things differently. Don't be afraid to make me repeat. Don't be afraid to make me rephrase. We all see and hear things differently, and it's my goal that we can get everything in place for you. And then John Novak says, the clear path room to a target is super important concept and one that you can fight it for years, but you will lose. Eventually you will give up and stop trading into lines that are wrong. Took him a long time to quit because he's so smart. That must be why it took me so long to quit. That was the challenge. When I was a brand new user, Caleb, John Novak taught this classroom. And it was him giving me the feedback that this is where I was making the mistake. This is how I fixed it, and this is where my money was. That's what set me in motion to finding these trades and then ultimately finding the other trades. So I appreciate that you would post in the room, that you would give me that opportunity. And you'll find that I can fix most anybody, except John Novak. Stubborn old man. The hardest thing initially is posting losers. It is. And guys, when I started learning the software, my last name was still Novak, which means that everybody in the room knew that I was related to John Novak. So everyone in the room, I felt, and it probably wasn't true, I thought everybody expected me to be the perfect trader right out of the gates because I had this genetic predisposition to being a badass. It turns out you've got to learn these things and you've got to study it. And the easiest way to get to where you want to be is to post the mistakes, because the mistakes are where you're going to learn how to avoid losses that are avoidable. So good stuff. Thank you for posting. Did that help a little bit, Caleb, or are you still drinking out of the fire hose? Which is okay. Awesome. And that's how this classroom works. I made every mistake known to man as a new user. I really did. I broke every rule. I traded into termination conditions. I fought trends. I fought momentum. But the one thing that I learned to do was to fix those mistakes. I learned how to eliminate them. I learned how to recognize them. I learned how to change. And it's just over and over. So I teach this class, Caleb, very much that when you enter my room for the first time, you know nothing. You're a clean slate, 100%. And I really try to focus on being able to, rather than teach you to be a day trader initially, get yourself talking about advantages. And once you start talking about these advantages, things begin to really fall into place. And these two right here, these are the most important, and you've already mastered one of them. So we'll work together on termination conditions a little bit, and then you'll start nailing those great entries that have a better chance of winning. I'm going to click on some of John Novak's charts. I'm going to go to the one that he said annotated. Because let's be honest, he is smart, and it's hard to understand what he's doing. So, and I'm going to show you why I teach the way I do. And John Novak, don't hate me for this. Perfect HVA short means jack squat to me. Perfect HVA short, that ever-loving snot does that mean? It means that price reached an area that the small chart turned, that John sold an HVA line short. So guys, when you annotate in the room, perfect HVA short, it is 100%. But you're not going to have any idea why it's the perfect. So write your rules on that, because this is the outcome of study. This is the recipe for getting there. So until you can know why it's the perfect HVA short, keep writing those rules. Keep writing those rules on your charts. Talk about the things that make it great. And eventually you just look at your chart and you say, holy crap, that's perfect. That's what it looks like on a Nexgen chart. But that's one of the reasons that annotation is so important. And guys, you're going to skip annotations because it feels like work. You're going to stop taking it. You're going to like, oh, it was a loser. I don't want to annotate it. I don't want to remind myself of the hurt. The losers are where it comes in, guys. The losers are where the money is made. So don't be afraid to post those losers. What else could we talk about? That was pretty cool. That was fun. You guys want to see the 3 trades on the plan? Here is the plan, guys. It is clearly written. From his 11:32 post, Steve. Did he post one at 11:32? 11:35, 11:34, 11:32. All right. So in this trade, I'm happy to talk about it. Large chart leads the way. First thing you'll notice, small's above the large, space between. So the 15-minute here has momentum, Steve, and it hasn't reached the area. That's the premise. Rules on chart mean old mark. I don't know what that means. Don't you have to go rest your back, Grandpa? So that's the premise, is that with momentum and nothing in the way, gonna look for opportunity. This is a kind of a mix of two. John says the large chart's up, there's nothing in the way, life is good, I can't wait to look for an opportunity. But I have this problem area right here. So what John does is he forces the 1 minute to get through trouble. And he says, all right, they're capable of breaking that area. And then when they pull back to that area, John finds an opportunity to trade with the large chart. Does that make sense? First, he has momentum, doesn't hit an area. He lets it break above the trouble here, and then he's just buying the pull back into it so that he can go with the trend on the way up. And John says this is why it's the perfect short, because it fits the rules. And his pain in the butt little brother tells him, you got to write the rules for the new kids because we're an educational room. Did that make sense, Steve? First, the large chart says, let's look for it. And then the small chart says, let's giddy up. And this is 4 contracts, $545 a risk. So risking what? About $150 a contract? Not even 150 a contract. Using the bottom end of that bar as a stop placement, and then once this breaks up, he'll probably reduce even more behind it. And guys, that's one of the rules. That's one of the trades that are on the plan. So I dropped the plan in there. I'm also going to give you guys this. I love to take pictures of trades. I don't look at stranded sellers. I couldn't care less about stranded sellers, Steve. I'm not going to lie to you. I don't look at the dots on the bars. The only thing I use market flow is the HVA lines. You can. You're welcome to. There's a wealth of information in there. I believe less is more. And when I look at this chart, Jim, I don't know. Probably not, since there's no markets and it's Memorial and it's a huge holiday. I'm guessing that there will not. So what's cool, Steve, is that when the rules are met here and the zone is defined here, these stranded sellers, like if that's your thing, great, look at them. But if you look at that bar, check it out. And this is why less is more for me. If you look at that bar, there's a million dots on there. There's buyers at the top, there's sellers at the bottom. That's cool, right? But that's a lot for me. What I want to know is, were my very simple, very basic best of the best rules met? It's easy to get caught up in the noise that isn't important. It really is. So guys, that's one of the reasons why when we're talking about this, we're talking about a very simple checklist that doesn't revolve around those dots, that doesn't revolve around your opinions or anything like that. Keeping it very basic, keeping it very simple, working on these simple looks, and then you'll find more as you grow. Good question, Steve. Great question. So I dropped in the trade journal all those pictures, guys, of HVA trades, of trend trades, of momentum trades, ideas on management. As you begin to practice and study, go through and look at these. Guys, add your own in there. Help me build this. That'll be awesome. You have the plan that talks about, here's your workspaces, here's how you use the two charts. These are where entries are taken, and then there's your checklist to do it. And then finally, just to help you guys out a little bit, I've created a little PowerPoint just to help out. So this is the rules for the high volume area trade, guys. Zone reach, triggers roll, buy or sell a pullback to that magenta line. And look at that. John Novak executed it perfectly. That's why he called it the perfect HVA trade. Not because it won, but because it fit the rules perfectly. So first, you get to your area, your zone. Next, you let the small chart show the change that you need to see. And then finally, you buy or sell that line. In this case, you would sell it. There is absolutely, let me pull up my charts, Miss Anna. All of your drawing tools are right here. So let's go to a two chart process. There's my circle. So if I circle it right here, you can see that because there's such a difference in the size of the charts, it's not very big over here. So you may want to exaggerate a little bit on the small charts. Maybe, if I can here. There we go. If you exaggerate just a little bit, it'll show up over here. And you can make a shortcut bar. So if the circle is what you're going to use the most, click on it, and that'll be one of your favorites. And then when you click on the favorite, it'll show it to you up here. So you go straight to that ellipse. And then you can move that off to the side if you want so that it's not in the way. So if you're going to do your trend lines as well, you can hit that one on favorites. And now you've got your two that you're using more than anything right there. Good questions. All right, guys, so the trend trade, no areas reached, no areas reached, buy or sell a close on the correct side of the triggers at the mid-band. So this is one of the differences between the Renko bars and the 1 minute bars. When you have that clear path, when you're going and you get the pullback to the mid-band, I was telling someone yesterday maybe, there's two things that are going to foster success with any really trading plan, but especially on TV, on TradingView. Number one is don't trade into the zones. Trading into the zones is a recipe for yuck, without a doubt. And then the second thing that I say is get in the habit of not fighting these fast triggers. These fast triggers are 1 minute immediate against you guys. And getting to the good side of them, closing on the correct side of them in the direction of your trade is this patience piece. And it really is. It takes forever sometimes, it feels like. But what you'll find is as much as you want to get at the mid band, it just doesn't go until they get to the other side of those triggers. And then our buddy Better Dad yesterday showed me this cool little thing you can do. So right here on the price line, if you come down to settings and click on it, where is it? Maybe it's, under more settings, scales and lines, countdown to bar close. There it is. So first it's in settings, and then it's in scales and lines. So this countdown to bar close right here, if you're waiting for a close on the correct side of the triggers, you can literally time it. You can see that I still have 21 seconds until that bar is formed and the next bar goes. So if I need it to close below these triggers, you can see where it's at. You can see the timing coming down. 7 seconds, 6 seconds, 4, 3, 2, 1. Hell yeah, go. And now I can time it out. Now I can force it to close below those triggers. Pretty cool, right? I love that trick. Better Dad, thank you for that. And that's what we're looking for. It's the same thing here. And then finally, there's that momentum trade. And that's what John showed you for the most part. Nothing in the way on the 15. Both charts are absolutely screaming. Buy or sell a pullback to an area, guys. Momentum, momentum. When it comes back to that area, buy it. Go with the momentum. What a concept. I love it. So those are the three. I'll put the PowerPoint in the room too if you want to take that. So you guys now have a plan with checklists. We've gone through the basics here of how to navigate a little bit. We've talked about annotation, ellipses, trend lines, all the fun stuff. And then Todd says, while you guys are doing this nonsense, I don't know, I'm checking this out. Strong top? Not at all, Todd. Are you in here, bud? If the triggers get through the area, it's not a termination. You had a clear path to the upside. So a strong top is a termination condition that reverses the market. Do you see how there's no termination condition present? And that's okay. That creates warm fuzzies, but it's not mandatory. And then what you have here, okay, no worries. So perfect. The question mark was implied, brother. So in order to have a strong top or bottom, first it has to be a textbook termination condition, and then your triggers roll. So this is a weak top. You had all the momentum in the world, but you didn't have a clear path yet. So this is kind of the lesson that we were talking about with Caleb as well. Your small triggers are absolutely, without question, below the areas that are problematic. But your large triggers are still above. And what that means, Todd, is this is a 50-50 look. With all that momentum, that area has the potential to break. But it's not a clear path yet. Does that make sense? So what you're doing is when you take this entry, you're saying with this much momentum, with the small triggers through it, this bad boy might break. What kind of document? That's a PowerPoint, David. That is a Microsoft PowerPoint. Hold on, watch this. File, save as PDF. Browse TV. David, there is the PowerPoint and PDF for you, bud. It doesn't matter. Even if you took the one-to-ones off, you see the big fib, right, Todd? So you actually have two areas with the potential to break. One is Fibonacci, the other is yellow 1-to-1s. Does that make sense? Both of them have the potential to break without a doubt. And then if we go back, you take a low risk entry at an area inside of triggers. So you take what's called a medium probability trend trade. And what you're saying when you take this trade, Todd, is, man, I'm banking on the idea that all this momentum and that path to the next area, that I'm guessing this thing has a potential to break. I'm willing to risk some money on it, and it's beautiful. And you say, well, where is all this momentum most likely to push it? Well, to the next area. And your exit is beautiful. And Todd, this is awesome execution on a 50-50 trade, on a medium probability trade. It's not the best of the best. You're welcome, Jerry. It's not the highest probability trend trade we teach, but holy crap, you have momentum. You have the potential to break. You have the perfect entry, and love you to pieces. You knew exactly where that market was likely to go, and you got paid there. Dude, this is awesome, Todd. You went and did it. Now you're going in the Hall of Fame. I think there's a lot of great information there. You're getting there, dude. You're getting there. It's a process, right? It's a marathon, not a sprint. Every day a little bit better. Every day a little bit clearer. Every day a little more understanding. And as long as you keep posting these pictures and telling me what you see, I'm going to turn it into lessons that you need. What does potential to break mean? It means you might have to manage. It never gave you a chance to manage. It went right to your target. Having live data makes a big difference. Yeah, I imagine. That's okay. Simulator's where you learn, right, Todd? Simulator is the right place to learn. I didn't get any better at golf going out and playing crappy golf. But when I started going to the driving range and focusing on the mechanics that produce the results, my golf game started improving. David, was the PDF good for you? And then that's where John has his shortcut. Mine just is horizontal. I don't know why, John. I've got the same thing. Mine's just, I suppose I could probably change it. Same thing. I like that though. I like having the tools readily available. You have the sidebar too? Did you take this one with your favorites and move it up here? Out of harm's way? I like that. Don't remember? Right on. Whew. Yeah, after surgery drugs are good. You wake up, turns out you were brilliant. All right, John, area down, triggers up, both support and resistance holding, which is the same as what 15 minutes says. Stuck between need breakout of areas will be easier. It doesn't have to be hard. I like that picture, John. Taking the pictures when it's time to not do anything. Guys, what else can I do for you before we call it a holiday? Miss Anna, did you get some of your questions answered, I hope? Vittorio, I know you had a few. I want to make sure you guys are good before we hang it up. Awesome. Repetition, guys. I can't stress that enough. Repetition. So over the weekend, even if the market's not moving, over the weekend, practice scaling. Practice doing all this stuff. Man, you're welcome, Todd. Thank you for being a part of it. Thank you for being a part of it. You too, guys. Jerry, tell your wife I said hello. When it's her birthday, I'll send her a happy birthday message. Time for a holiday beer and a cigar. I love that. I don't like cigars. I was a cigarette smoker for decades, and I inhaled cigars, and just they make me sick. I love the smell of them. I want to sit next to you when you have a cigar, David. I don't want to have one with you. Beer 30. I like it. That sounds like a good plan. Let's go drink a cold beer. I will. We will come to Phoenix at some point. Phoenix is on the list for wintertime contracts. Phoenix, Vegas, We keep looking in Sarasota, but they don't value my wife's talents down there as much as they do in other parts of the country. Look at this, guys. We got above the thing that was keeping us patient, right? Now price is going up. Price is going up. We're above the zone. I feel like this is an appropriate time to put a limit order just above that HVA line. Jerry, I'm going to be really honest with you. It's going to scare the ever-loving crap out of me. I would love to, though. I would love to. I'm going to get as close to panicky as you can, but I'm pretty good harnessing fear. I think I would. I love the adrenaline. I used to race motorcycles. I love the adrenaline. Used to run face first down cliffs and snowboard backcountry, and now you get to be in control. I don't. I think that's what scares me. So, all right, guys, we're going to call it. You guys want to see if the HVA line holds with strong triggers up above the zone? You guys want to watch this before we close it down? If I click and I say buy limit 2, I don't even know if they'll come get me. If they do, outstanding. If they don't, what are you going to do, right? Let's see what happens. All we can do is call our shots, right? All we can do is follow our rules. John's like, you're slow, Novak. You missed it. It was perfect. I like it. That's a good looking trade, John. Momentum trade off the top of the 1-to-1s. Gosh, you've been teaching that trade for 20 years. Textbook perfect, non-annotated. I'll annotate it for you. Strong triggers, let it break above the area, buy the pullback to the area. Giddy up. I mean, it's not any pretty, it doesn't get any prettier than that. Nicely done. Guys, they may not come back for us. Maybe they will. Those 1-to-1s might slow things down. I don't know. That's the beauty. I have absolved myself of the desire to know what's going to happen next. Doesn't matter. All I can do is follow my rules. Uh-oh. They're trying. They're trying. Anybody have big plans for the weekend? You going to go have some fun? Let me